All right, good morning, everybody. Little early. All sorts of great questions coming in this morning, and I apologize if I feel like I'm not answering them quick enough, but I have to set up for class. Some days I hesitate to post in the room before class gets going because it opens discussion, but I really do like the discussion, so I get drawn right in. Hope everybody's doing well today. Hope you guys are ready to go. You're happy. Grant, to answer yours real quick, large chart always leads the way is the easiest way to answer it. So the large chart leads the way. So if the large chart has that odds favorable momentum and absolutely nothing in the way, it makes it easier to hold for bigger moves. But there are conditions on a smaller chart that may take you out of holding for that home run. For example, three divergences, divergence from a one-to-one, second lower divergence. So it's really this dance. The large chart leads the way, but the small chart, because it's faster, will give you indications when it's time to manage out. And I hope that makes sense. And we'll go a little further into management today. At the tail end of the slideshow that I use, there's some great management pictures. Um, and I'll tell you what, just in case, because I know that you're pretty solid on what I talk about in the first hour. There's the slideshow that I'll be using for everybody. Grant, feel free to skip ahead to the end. Management in the slideshow starts, let me find it, right around picture number 25. Sorry, apparently I hit the mute. Did we miss all of it? Did you guys hear anything? Or did you just lose me? Gremlins. There are gremlins. Okay, after large leads. Thanks, Ron. So Grant, let me go back. Management, large chart leads the way, always. Large chart, if you have odds favorable momentum on the large chart, if there's absolutely nothing in your way on the large chart, that's that hold for bigger moves look. But if you end up with a second lower divergence, or you end up with divergence from a one-to-one, or maybe three divergences on that smaller, faster chart, then you may need to manage out of the trade. So good morning, Miss Debbie. So the large chart's going to lead it, but the small chart's going to show you change that you can't see. And I dropped my PowerPoint in the room for you, Grant, just in case you don't want to sit through momentum and termination conditions again. Right around 25, it starts going into management a little bit. There's some great pictures there that I think most of you will find helpful. Whoops, there we go. So, and then of course, guys, if you have questions about anything that you see, if you open up that PowerPoint, you're like, man, this one doesn't make sense. I want you to talk to me about it. Gino, don't let me get away from, we're going to have a great lesson on the looks of trigger lines as well. That's going to help you a little bit on making those decisions for that long. Guys, we're going to talk a lot about patterns. We're going to talk about the patterns that repeat themselves over and over. We're going to talk about having a set of rules that not only are easy to follow, but you have to believe in them. You have to believe in your rules, or you're going to be subject to that emotional override that comes in and forces you to make decisions based on what your guts want rather than what your indicators tell you. And we're going to do all this today, guys. We're going to have a blast today. We're going to do a lot of chart reading, but we're going to start our day like every day is we're going to look at news. At 8:15 we had news. It was kind of a dud, but at 8:30, excuse me, if you were watching the NASDAQ at 8:30 a.m., somebody or several somebodies with a lot of money decided to fight. And man, they moved that market crazy. It went so fast. I'm glad I wasn't in a trade. You can't predict those. You can't predict those because there's no news. There's no reason. It's just somebody with a lot of money moving the market. And it's a humble reminder that you're not in charge. You're not in charge of the movement of the market. You have absolutely no bearing on whether it goes up or down. Your wishes and desires are not going to make areas break. We're at the mercy of the people that move it, which is why it's so important that we always have a statistical advantage going into trades. Good morning, Andy. Nice to see you. And then, guys, Wednesday, we've got high impact news. That was that ADP non farm employment change. And then at 10 a.m., guys, Fed Chair Powell testifies. So let's talk a little bit about when Powell testifies. And it's very much like when it's crude oil inventories. There may be jockeying for position coming into it. And let me see. That's crude oil. Guys, I want you to see what the NASDAQ's been doing for the last, since 8 a.m.? Just, guys, they're fighting. They're caught in a range right now. The faster you recognize the range that they're trading in, the easier it is not to take that long into resistance or this long, to not trust that 50-50 with a couple divergences, right? Not trading short into this termination condition. What happens is, and this is going to come back to rule number 2, is defining a range that this market that you want to see it break out of. Because otherwise, the only way to really take advantage of it is to trade from area to area because there's not a lot of room in between areas. So recognition of what the market is doing is going to help pay dividends. And when I see a range-bound market, I've got a very clearly defined area where it needs to break or where it needs to hold. So they may be doing that because Powell is testifying at 10 a.m. I want everybody to set a timer on Siri, write it down, big post-it note in the middle of your screen that says 9:55, let's shut it down and go grab a cup of coffee. Jolt's job openings are going to affect it as well. Guys, we're not trading the news. We just want to know when people might get a little crazy. 10:30 a.m., crude oil inventories. They're going to release the inventory numbers. And there's probably people waiting to make a decision on it. And on crude oil days, when the inventories are there, once again, let me show you the effect that news can have on the market. There's a huge scramble for almost 4 hours right at key areas, and then eventually they break and they head off to the next key areas. But these are kind of the troops grouping up, getting ready. So understanding the news doesn't set you up to take advantage of the news, but it keeps you from getting caught in that emotional fight, those reactions from the news. Then everything that we talk about each and every day, guys, it's going to come from the education page. 2 key sections here. There is a software user guide. This is all of your NinjaTrader stuff. This is how to open, how to close, how to take pictures, how to share pictures, how to scale charts, how to set up stops and targets, how to get rid of everything and start over, how to use market replay. Everything that you need with NinjaTrader is right here for you. I always encourage you guys, ask me in the room if you have questions about it. But if class isn't in and you need a little help, that's where you're going to go. And then the tutorial section is where all the answers come from. Everything that I talk about comes from the tutorial section. And down at the very bottom, there's a glossary of common terms for you newer folks coming in. There's a lot of great stuff. Well, I heard him say one-to-ones in class. What is that? What's a small swing? What's a reversal bar marker? It's cool to go down and get used to the terminology a little bit. It makes it easier to follow along, to participate. But I think the most important definition for us this morning is the high probability trend trade. And this is a trade when each and every indicator on the chart agrees for the trade. Triggers are going to be the strongest. No termination conditions exist. There's no trouble spots between your entry and your target. This is what we're going to talk about for the first hour today, guys. We're going to focus heavily on the high probability trend trade. I'm also going to introduce you to a medium probability trade, which is when most of your indicators line up for a trade, but a problem exists. And we're going to do this over the course of the first hour. We're going to talk about this high probability trend trade. We're going to talk about the rules that come from it. We're going to talk about the advantages that those rules provide. And we're doing it because you need to be a chart reader. That's like the most important skill that you can learn as a brand new user, is learn to be a chart reader. Learn to just simply look at your indicators and understand what they're telling you. That's what the high probability trend trade is designed to do. It's designed to get you focused on reading advantages. It's designed to get you focused on understanding when the market's doing what you need it to do so that you can take a trade. And it's going to be about 90% of your day. It really is. It's going to be about 90% in the beginning where you're patient, you're waiting for a statistical advantage. excuse me, each and every time you take a trade. Because guys, like I said earlier, we don't control the market, not even a little bit. It's going to go up and down with or without us. So what we have found over 27 years of being Nexgen is that the market goes up and down pretty predictable. There's certain patterns that happen within the price structure, within the trigger looks, within the areas that allow us to capitalize, to take this high probability trend trade. And it's a trade that typically wins 70 to 80% of the time when you're following the rules. You'll understand through your chart reading where the market is likely to continue, and this is going to allow you to enter the market at the correct spot. You're going to ultimately understand where the market is likely to go. Grant, that goes back to your management questions. And then you're going to understand where the market is likely to stop. And once again, Grant, that goes back to your management questions. Understanding these concepts is going to get you into the market. It's going to have you looking for appropriate targets, and it's going to let you know when it's time to not take trades anymore. And that's really the goal. But the first hour is trade entry precision. Getting into the market at the correct spot creates manageable trades. And then trade management is the second piece of the puzzle. So we're going to focus heavily on getting into the market. We're going to focus exclusively on finding the best entry for the high probability trend trade. But I have to remind you guys that the easiest way to get to where you want to be, and I know I sound like a broken record, post your trades in class, post your pictures in class, post your questions in class. That's the quickest way to get to where you want to be. And then the second part of that is use your spreadsheet, guys. There's 3 tabs on the spreadsheet that Nexgen gave you. I'm going to give you mine. I share mine every morning so that you have one. Please save it. Your first tab is nothing more than a trade journal, guys. And your trade journal is where you're going to come through and you're going to record every trade that you take. And that's it. Just the trades that you take. Win, lose, or draw. Good, bad, ugly, anything. You're going to drop it in here and you're going to talk about it and you're going to say, I was relaxed and I had these advantages and I won, I lost. And guys, when you're on simulator, it doesn't matter if you win or lose. What we're doing is we're learning the looks and we're practicing getting in and out of the market and moving stops when it's appropriate. But then there's a notes section over here on the side where I'm going to give you feedback on everything that you put in the room. Maybe your entry is a little early. Maybe your exit's a little late. Maybe you misread some trigger lines. We're going to get to talk about that and really focus in on your chart reading and help you get better. So if every morning you go back and you study the previous day and you ask yourself what worked and what didn't work, what felt easy, what felt forced, you're going to start to recognize the patterns that are bringing you success, and then you'll recognize the patterns not only in the market but also in yourself that might be pulling that success away from you. And this brief historical study each morning is going to prepare you for the day and it's going to accelerate the learning. So filling up this first page is important. Every time you take a trade and the feedback is, man, great work, that's it, that's the best of the best, that's what we're looking for, you should add it over here to your favorite trade setup looks. This is you building your personal trading plan. This is you taking that recognition, those statistical advantages, that visual representation of the patterns that are going to get you where you want to be. And what you're doing is you're building a trade plan. You're creating confidence and trust in the looks. And until you have that, there's about 300 pictures in the green section of Nexgen users using the software. It's not all high probability trend trades. Some are medium probability trend trades. Some are a little outside of those high probability trend trade rules, but what you'll find if you go through and spend a little time is that they all revolve around advantages. They all had more things going for them than against them, which is why these people took the trades. You're going to develop your plan, and it's important that you have your plan, that you personalize it, that you own it. But this is going to help you get there. It's going to help you with entries. It's going to help you with management. You're going to begin to see patterns that repeat themselves over and over. And there's also a whole section on where the market is likely to stop, termination conditions, because that really is the most broken rule for new users. And then for you NASDAQ traders, you adrenaline junkies, I put a whole section in there. I went through the hard work of blowing out about 10 Apex accounts for these great lessons. So take them and use them, please. And then we're just going to learn the rules this morning, guys. We're going to take our first hour and we're going to talk about the high probability trend trade. Good morning, JW. I'm going to focus on the rules. I'm going to talk about the rules. We're going to see them visually. We're going to go look at the live market and recognize them. Guys, simulate all day, practice. There is no loss of risk or capital if you're on simulator, if you're participating in class. All it is you getting smarter. We're going to simplify that high probability trend trade. I'm going to introduce you to a medium probability trend trade. And the idea is you have to learn the looks so that they're easy. You have to know the looks so they're easy. Somebody said in the room once, damn, Mark, you ask us to take so many pictures. Guys, if you look at 300 pictures of a high probability trend trade, if you take it, if you go through the process of writing on your chart what it is that you see, I see strength and I see a good top and I recognize that termination. Guys, this exercise is 100% cementing these looks into your brain. You're associating advantages with looks, and that's why I have you annotate charts so much. That's why it's so important that you present these in the room, that you get this feedback, because every time you take a picture, you're going to see the things that provide success, and you're going to see the things that rob you of success. And your brain, like it or not, is going to latch onto it, and you're going to become an amazing chart reader and a wonderful trader. And we're going to start with the high probability trend trade. This is the first, guys. This is your foundation. You will not be exclusively a high probability trend trader. There's no doubt in my mind, and I say that with the utmost confidence because it's boring as hell to wait for only high probability trend trades, and the average brain can't do it. But by learning the high probability trend trade, you're going to be able to recognize at the drop of a hat the advantage of momentum, and you're going to be able to recognize a clear path, and that's going to allow you to pick your entry area. Each of the 3 rules for this trade provide an advantage. And I want you from day one, and I know I've got new people, Kenny and David H. and Arnie, I want you to speak to yourself in terms of advantages every time you look at your chart. I want you to talk about whether or not these are present and really commit yourself to being a chart reader before you're a trader. So we're going to take these three rules, we're going to take the 3 advantages, and that's going to create a trade. We use a 2-chart process. For the brand new user, it's a 2-chart process. Simplicity is key, guys. The easier you make it, the faster you'll learn it. The large chart leads the way. The large chart tells you exactly what the people in charge want to have happen. The large chart defines direction, it defines momentum, and it identifies areas. And this broad stroke of a brush gives just basically the general opinion of what the market's doing. It lets you know what the people in charge, the large crowd, want to have happen. And guys, the large chart's just this broad stroke of a brush. Your first 2 rules happen on the large chart. From the most current bar, you'll understand the direction of the market. You'll understand whether or not you have momentum. That's rule number 1. And you'll understand whether or not you have a clear path to get to your target. That's rule number 2. The small chart is going to be where we find that entry, where we refine that broad stroke of a brush. What happens in 1 bar on the large chart is a 20 to 30 bar endeavor on the smaller, faster chart. It's like an X-ray, and we're going to be able to use it to refine exactly where the market is likely to continue, to pinpoint with accuracy our entry point. And guys, that's rule number 3. And it's going to allow you to increase your profit potential. It's going to let you reduce your risk. And rule number 3 is dependent on the small crowd, the people that fight the large crowd, the people with just enough money to give a shove, but not enough money to change the trend. We rely on these guys to get us into the best of the best spot. And we're going to do it with a high probability trend trade. So, rule number 1, I must have strong trigger lines. I've gotta. I was talking to someone this morning via email, and he told me he's a momentum trader. I'm a momentum trader now, Mark. I love the momentum trades. Well, the reality is everything Nexgen teaches is really a momentum trade in some form or fashion. So strong triggers, the advantage of momentum on that large chart, can only happen if you're trading with the trend, if you're trading with the direction of the market. If the background on your large chart is green, the market's going up. And as a brand new user, you should only be looking for rules to be met for high probability trend trades long. If the background is red, the market's going down. You should only be looking for rules to be met for high probability trend trade short. Guys, this right here is a huge safeguard. And it's going to keep you out of an awful lot of opinions. And the only way that I can have strong triggers, the only way it's even possible, is if my small triggers, the solid lines, and the large triggers, the dashed lines, if these are the same color as the background. If they're not, if the large are green and the small are red, I don't have strong triggers. The only way it happens is if the small and the large are green, if they're wide and angled in the direction of the trend, and then it's the separation between the two that lets me know that the odds are favorable for the market to continue in the direction of the trend. And odds favorable momentum is going to be that battle cry that you hear in class all the time. And you're going to notice the people that are posting pictures. You're going to see more winners with momentum than without. So like scissors opening, it's the space created. And guys, there's this cool life cycle. And Gino, this one's for you. You'll see times where your trigger lines are beginning to accelerate, right? So there's a life cycle for trigger lines. Strong triggers are the separation, but in most cases, there's an acceleration point where they begin to break away, where those scissors begin to open. And when you see this, look, that's the first step, that's the first part. And then the separation means that we're really cooking, and the wider it gets, the better it gets, guys. So the scissors have to open, they start closed, but as they open, you're going to begin to recognize the beginning of momentum and as it progresses. And in a downtrend, small triggers below the large triggers, both are wide, both are angled in the direction of the trend. The colors all match. That space between the two, the scissors are open. The odds are favorable for the market to continue down. I can't stress the importance of odds favorable momentum enough. And guys, because when we have strong triggers up, when we have strong triggers down, we are going to buy Fibonacci support in an uptrend. We're going to sell Fibonacci resistance in a downtrend on that smaller, faster chart. You're going to refine your pinpoint, your entry on a smaller, faster chart. On a large chart, on that slow-moving creeper of a chart, it's going to look like a tail at the bottom of a bar or the tail at the top of a bar. You're going to use that refinement chart to buy low and sell high with strong triggers. Odds favorable momentum is the best of the best, guys. This is the one that sets you up for success. This is the look that is capable of breaking key Fibonacci areas. This is the look that's going to cover some of the mistakes that new users make, the reason that we hold for bigger moves. And guys, this is the advantage that if I had to encourage you to never let go of one, this is the one that I would say never let go of. As the scissors begin to close, with both triggers down, when one of the two small triggers is inside of the large triggers, this is the first sign that momentum is slowing, guys. And short trades can still be taken if the other charts agree. If everything else is perfect, go ahead and take that short trade. With both triggers down, once both small triggers are inside of the large triggers, you have a weakening or a slowing of the trend, and anything can happen up or down. That's the term you're going to hear in class, guys. We're going to talk about OFM, odds favorable momentum. We're going to talk about the old ACH, anything can happen. And you'll get to a point where short trades can still be taken, but they have to be managed aggressively. The entries have to be perfect. The path has to be clear because we're no longer in a position of momentum. So let's go to a large chart. And this is crude oil, guys. And I want you to see just momentum. And Gino, there was that acceleration look. And there's more factors that go into this. But I want you guys to notice that the smalls are breaking left. They're breaking away from the large. They're accelerating up. And that's the beginning of momentum. And then that momentum carries it all the way to the key area. And you can begin to learn trust, strong triggers, by a pullback. And that's kind of the basis of everything we do. Strong triggers, buy a pullback, strong triggers, sell a pullback. And you see it over and over. So I want you guys to not be shy about going back, scrolling back 10 days, taking pictures of this momentum And guys, this is how you're going to get good at what you're doing. Let's take a picture of this chart. Is everybody comfortable with the idea of strong triggers? Strong triggers down, sell a pullback to Fibonacci resistance. That's it. This is your plan, guys. Watch this. Strong triggers up, buy a pullback at Fibonacci support. And if you go back on your large chart and you circle these tails that you see with that odds favorable momentum, guys, that's going to set you up to go see if there were entries on a smaller, faster chart. This is how you're going to study this trade. And this is only one part of it, guys. This is just momentum. But look at how far the market moves when that momentum is the absolute strongest. You're going to take advantage of that momentum. You're going to be able to find trades inside of all that motion. Gino, there's your acceleration look again. Do you see it? This is the beginning, potentially, of things accelerating. It's not there yet, but it is getting close, and if it's going to happen, that's a pretty good look. All right, so rule number one gave us strong triggers, guys. Strong triggers break things. Strong triggers push a market. Strong triggers cover mistakes. Now we have to make sure that we're not trading into an area, that we're not trading into some place that may stop the market. This is rule number two, guys, and when termination conditions are false, when you have room to your profit targets, you have a clear path. And we're going to couple that with momentum, and that's what's going to have us looking for an area. So the large chart has already told us that the market is going up with the most current bar. The large chart has also told you that there is momentum. There's space between the small and the large. So now we're going to let it define areas, guys, and areas that may stop the market, that may reverse the market. Blue Fibonacci support, red Fibonacci resistance, yellow 1-to-1 dots, cyan divergence highs and lows. We're also going to look for three divergences in the same area. Large chart midbands if the triggers are full bar away. Notice there's a little more information here. A little more study has to go into this one, guys. This is the rule that gets broken the most. But these areas can cause trouble. These lines on your chart are where decisions are made. These are where buyers buy and where sellers sell. And these are where profits are taken. Trades are entered and exited. And the reality of it is that you don't ever have to be caught up in that decision making. Because remember, you're not the one moving the chart. It's the large crowd. It's the people in charge. And these are the areas they react to. And these may reverse the market, but it's based on a comparison of the area and the T3 trigger strength and location. Those same trigger lines that gave you momentum are going to help you determine whether or not you've reached a termination condition. So there's three options. The first one, and let me clarify what I mean when price reaches an area. These dynamic Renko bars are nothing more than a representation of price. From 53.53 down to 53.43 is 10 ticks in price. Price went down 10 ticks. So when price, dynamic Renko bar, reaches Fibonacci support, check the trigger lines. And if they're not below the support, don't take any more trend trade shorts on the small chart. How easy is that? If price reaches an area and the triggers remain above, don't go short. This is an area that may reverse the market. It's an area that may stop the market. Well, if that is a termination condition, what's a clear path? A clear path is when both the small and the large, it's key that both get below support. Now support's broken. It behaves as resistance. And guys, you're going to see this all day long. Areas break all day long. If they didn't, we'd be caught in this little rattly range. Areas break with odds favorable momentum. They rarely break with weak triggers. It happens, but it's rare. So when the small and the large break, my path is clear. If I haven't reached support yet, and I have momentum, I'm looking to pinpoint where the market is most likely to continue. And guys, that's that tail on the large chart. So price reaches, no triggers, no trade. We're at a termination. Small and large get to the other side. The area is broken. The path is clear. Is everybody comfortable with that very basic concept? Price reaches, no triggers, no trade. It's a termination. May create a bounce. There may be a fight. It may reverse. When the small and the large get beyond, clear path until you reach the next area. And then guys, there's one more look. When the small triggers absolutely smash 2 to 3 points through an area, but the large triggers haven't made it yet. Remember, it's a slow moving chart. This means that this area has the potential to break. 50% of my triggers are through and 50% are not. Guess what we call this trade? The 50-50 trade. If there's an opportunity and the opportunity doesn't sacrifice momentum or the perfect entry, we'll take a shot at these areas breaking. They are not high probability. These are a medium probability trade. And the issue that exists is the path is not clear. Rule number 2 isn't met. But we'll rely on rules 1 and 3 to try to carry us with that momentum off to the next key area. So 90%. Price reaches resistance. Triggers are below. No long trades. You guys just avoided a loser thanks to rule number 2 because it pushes all the way down to support. Price reaches support. Triggers remain above. No short trades. Once again, you guys stayed out of a loser because rule number 2 is designed to keep you from trading into areas that may reverse the market. When I reach this fib, when I get close to that mid-band, guys, and those large triggers don't follow, there's room for an entire bar. That's what makes a mid-band a termination condition, is that big gap back to the large triggers. We actually call it the gap theory. And it behaves like a vacuum. This is totally Hoover, sucking price right back up to those triggers. So if you accelerate away from the large triggers, you smack into a fib, a mid-band, one-to-ones, divergence lines, whatever it may be. If those large triggers don't follow, guys, it's probably going to come back up to them. From there, it goes into resistance, a divergence high, and a second resistance. Let's talk about divergence real quick. Divergence is a loss of momentum. That's it. Divergence on its own means that the buyers pushed up, the sellers stole their momentum and pushed the other way. A negative number will print. It doesn't matter what the number is. And then this magenta line will print as well. This magenta line is a visual representation that the move lost momentum. It is not a termination condition. Remember that the recipe for a termination condition is that price must reach an area, not create an area. So when price comes up and reaches resistance, each and every one of you are asking yourself, where are my trigger lines? And if they remain below, you're saying, okay, I'm not going to go long, even though my triggers are green, because this area may reverse the market. And it pushes up a little more and it catches that divergence high, and you go through the same process. And then the second one, same process. And then when price trades above a divergence line or below a divergence line at a low, and then back below, we call this a pivot stop out. Pivot stop outs are strong. They're even stronger when they coincide with Fibonacci support. So let's talk about the spoils of patience, guys. No longs into support, no longs into resistance, no shorts into support, getting frustrated, no longs into resistance. I don't know how I'm ever going to make money. And then this termination gives you a full reversal, guys. The large go red, the smalls are below, the momentum is strong, right? We call that a strong top when a no triggers through termination reverses the market, or a strong bottom if it happens at a low. From the strong top, we get odds favorable momentum. There's that separation between the two, between the small and the large. They're wide, they're angled in the direction of the trend. Rule number 1 is in place. I've reached a mid-band, but the large triggers aren't a full bar away, which means this is not a termination condition, and I have room to get to support. So now I have momentum, and my path is clear, and then you guys just pinpointed that entry, that little pullback on a smaller, faster chart. Each and every one of you got in based on rule number 3 and took that at least down to Fibonacci support. What you don't do when there's nothing to do is going to help you keep the money you make when you're following the rules, when you're having those advantages, guys. And happens all the time. Strong triggers break support. There wasn't an opportunity, and everybody begins to get frustrated. Price reaches the yellow one-to-ones, and you're thinking to yourself, man, I didn't get short here. All that money was made, and I didn't get a penny of it. Let me try to go short into this area that may reverse the market. And it pretty much separates you from your money. We would lovingly call that financial suicide when you trade into a termination condition. The buyers push, The sellers couldn't go down. Notice that all your triggers remain below this resistance line, and then your trigger lines don't match in color. Guys, you are totally out of the loop. There's no rule number one. There's no rule number two. And this goes on for 45 minutes. There is a fight between buyers and sellers for nearly 45 minutes. Eventually, you do have momentum off that termination that created a full reversal. All your trigger lines got above resistance. It's now behaving as support. And then once again, rule number 3 has you pinpointing where the market is likely to continue. It gets you into that highest probability trend trade, the one that typically wins 70 to 80% of the time. And the momentum carries you to the promised land, all the way up to Fibonacci resistance in the distance. Once again, 90% of your day is doing nothing. 90% is waiting for advantages. 10% of your day is kicking ass and taking names because the advantages are present, guys. And that's all we're learning right now, is to understand when the path is clear, when it's not, when the momentum is strong, when it isn't. And we're going to work that into being able to grab an entry. But before I do that, sometimes the market seemingly turns from nowhere. Whether it's a bottom or a top, it's a pivot, it goes up, strong triggers, it goes down. I'm going to give you another termination condition. And I'm going to remind you before I do that on the large chart, lines can be problematic. Lines can be issues of concern. On a small chart, lines are going to get us into the market. Lines are going to give us a place to bounce to continue. So on the small chart, the only termination condition that I'm ever going to respect, the only time I'm going to say, whoa, rule number 2 isn't met, is if 3 divergences print in the same price range. 3 losses of momentum. Visually, 3 cyan lines from a low, 3 magenta lines from a high. This lets me know that the market may reverse. And guys, there's that very key word, may. It may reverse, it may not. But patterns have proven that my statistical advantage of a clear path is gone. It's absent. It's no more if 3 print in the same location. So from a low and a high, the small chart's going to help you see the change that you can't see on the large chart. Small chart's going to tell you don't take that last long, rather than just getting run over and wondering what the heck happened. These 3 divergences, if you cut off the first one, this is going to be one of your management tools. So Grant, here's one for you as we talk about management. If you're in a short trade and you get 2 divergences and the second one is higher or the second one is lower, or if it's 3 divergences, the third one is higher, the third one is lower, guys, this is the jump ship look. This is the, man, things are changing. It's not perfect. Let's get out of that trade and let's wait for the advantages to come back. And you're going to see this a lot. So small chart can help you manage the read from the large chart. And guys, let's go back to the live market because I want to do this a lot. And let's take a look. This is the easiest way to develop trust and termination conditions. Price reached resistance, not one trigger line broke through, guys. And look at the push. Thank goodness for rule number 2. Large triggers didn't follow and it closes the gap. Oh, look at that. None of the triggers broke through here either. From termination to termination. And then the small and large get above, the momentum is strong, and I'll be damned there's one of those tails. Hopefully some of you guys were in at 60-ish. Made a little money. If I scroll back, resistance breaks and behaves as support. No triggers through and it pushes down. None of the triggers get below support. Look at the fight that happens. Strong triggers break areas. 1-to-1s, no triggers through, can stop a market. Guys, you're just taking these lessons. Only the smalls broke. It never broke, and ultimately it rolls, reverses. There's your entry. Over and over. And then one more. When that market doesn't come from an area, that's a bad bottom. When a termination reverses the market, that's a good top. Notice that the bad bottom pushed up to resistance and then came down. Starting at this point right here, your sellers were looking for this support. And they pushed down and the buyers pushed back and we capitalized. And they pushed down and the buyers pushed back and we capitalized. Bad bottom, straight to resistance. We capitalize again. And then it's target reached. They finally hit the fib. Guys, and that is 3 hours later. The sellers finally made it. We knew where they were going. And look at that. That's what turns the market. They're satisfied. They got where they wanted to get. And sure enough, they allowed the market to be pushed up. Guys, these are the fights all day long. These are the fights that you don't have to be a part of. And you'll notice the indecision tends to happen right around key areas. So rule number 2, get that clear path. This is the most broken rule by new users because we get so excited about being in a trade. We get so stinking excited about being in a trade that we forget to make sure we have a clear path. So, and then CAV, buyers and sellers fighting on the NASDAQ, probably because in 25 minutes, Powell speaks. They're probably jockeying for position right now. Not anymore, they broke out, cool. Large chart, define direction. And guys, I want to make sure everybody's comfortable with this. So newer users, give me a Y if you're with me. The background is green, therefore we're going up. Give me a Y if you're with me, guys. Let's make sure everybody's on base. I can't see your faces. I don't know if you're with me or not, and I don't want to leave anybody behind. Most current bar says up. Most current bar says strong triggers. Small's above the large, larger wide, space between the two. Everybody's good? Large chart has not reached resistance, and it has cleared the previous resistance. The path is clear. The large chart's giving me the advantage of momentum through rule number 1, strong trigger lines. It's giving me a clear path through rule number 2. So now I have to go to my small chart. Now I have to go, and I'm going to use a limit order to buy or sell a pullback at areas inside of triggers. Guys, rule number 3 is going to pinpoint where the market is most likely to continue. Rule number 3 is going to give you the absolute best of the best, lowest risk, highest probability entry, and it's going to do it by buying or selling a pullback. And a pullback is a retracement in the price, typically 10 to 12 bars. And this retracement needs to come to an area, fibs, mid bands, yellow 1-to-1s. And then here's the big one, guys. Those areas need to be inside of trigger lines. So there's a lot of words, and I want you to get in the habit of writing those on your chart. The idea is that these moving averages, these large triggers, and then the synthetic triggers, which are just the large triggers from your large chart, when these are overlapping one on top of the other, two snakes riding piggyback, guys, this is the best of the best look because there's just not much room to shove areas into, which means that you have the smallest window of opportunity, the smallest point where the market is most likely to continue. And these small points of entry create very low risk trades. So this is what we're going to focus on. Favorable large triggers, guys, means that they're one on top of the other. The more spaced out they become, the larger the risk, the more indecision, because the further you put those two correction points from one another, the more difficult it is to determine which correction point it's going to go to. Your risk grows exponentially. Favorable large triggers is like 32 flavors of awesome. And what we call split triggers, that separation between the triggers, makes it a little more difficult to manage. It makes it a little more difficult to control risk. And you have to make the decision as a trader in your own personal plan whether you're willing to wait for the best of the best or whether you're willing to leave an indecision, a little indecision there. So that's up to you. But I'm going to tell you that the tighter they are on top of each other, the easier life becomes. So we're going to let the small crowd push us back to an area inside of favorable large triggers. Our large chart said go. We're going to buy low if everything says up. And our large chart said strength to the downside. And we're going to sell high on that smaller, faster chart. And this refinement process allows us to do that. The one bar on the large chart that gave us direction, momentum, and a clear path, inside of this one bar, if you take an X-ray, which is the small chart, you're going to see 20 to 30 bars, guys. You're going to see all of that movement within. And you'll notice on the small chart, look at all of the fluctuations, guys. This shows you all of the fight as that small crowd tries to push back. And what we're going to do is we're going to recognize the bottom of the most current bar. That's going to signal the beginning of a pullback. The top of the bar, that wick or that tail where we sold, should be up here at an area inside of favorable large triggers. Our objective is to sell high because it reduces risk. By selling high, we increase our profit potential. And we're going to do that with the simple process of identifying areas inside of favorable large triggers. So we're going to go through the whole start to finish. And you know what? I'm going to pull it straight from the spreadsheet, guys. When the large chart has odds favorable momentum, when the large chart has a clear path, and if it comes from a termination that created a full reversal, guys, rules 1 and 2 are met. I have room to my target, I have the best momentum ever, and I'm coming from a termination. Decisions were made at support to reverse the market. This is the look you should never do without. So now I'm going to turn my attention to the small chart. And on the small chart, everything is screaming up. Everything is flying to the upside. And this is where new users start to get a little nervous. They're like, it's going to go without me. What am I going to do? I'm ever so scared. And then through repetition, guys, you're going to develop trust in the idea that it's okay. The market moves in up and downs. And we need to wait for the down on the small chart. Remember, the large chart's always going to say up, but your small chart's going to give a reversal bar. This reversal bar signals the beginning of a pullback. It is not a pullback. A pullback is going to be 10 to 20 bars coming down. This is only a reversal bar, and a reversal bar signals the beginning of a pullback. So once you see a reversal bar, let's look for those trigger lines. Let's look for the large, for the synthetic. Doesn't matter which is on top of which, but the tighter they are, one over the other, the smaller your window is going to become because your areas have to be inside of those triggers. So once I define where the trigger lines are, I'm going to take a look for my areas. Areas can be Fibonacci support, yellow 1-to-1s. It can be a mid-band. But the key is they have to be inside of favorable large triggers. And I want you to write that on your chart every time you take a trade. Was my area inside of favorable large triggers? These moving averages are a correction point, but price just pulling to the correction point isn't enough. We want to give it something to bounce off of. That's what the areas do. And guys, from the top of the window, which is the highest point of support, to the lowest point in the window, this is your window of opportunity. This is where the market is most likely to continue. And all you're going to do is you're going to activate a limit order right at the top of that window, and you're going to wait to see if the small crowd can get you into that trade. If they do, fantastic, you're in. If they don't, not your money. I want you guys to avoid the temptation of just jumping into the market. So the reversal bar starts the pullback on the small chart. We don't get in on the reversal bar. The reversal bar lets us know to look for our triggers, large and synthetic. And when price pulls back, we don't get in at the triggers. We get in at the area inside of those triggers. Here's the mid band all the way down to 1-to-1s. The cyan box represents your window of opportunity. We're going to get in at the top because of the momentum and the clear path on the large chart. Guys, this is your entry. If you have questions about entry, right now is a fantastic time to ask it. Large chart says down. Large chart says strength. I wait for the reversal bar, and at the time of the reversal bar, I identify my triggers. Once I identify my triggers, I look for the areas within, and I activate my limit order just below. Guys, this is your entry. This is your first 30 days with me, learning how to recognize where the market is most likely to continue, and doing it on 2 charts. We don't trade tails, ever. But if you circle the tail on the large chart when there was momentum, when there was a clear path, if it lines up with support inside of favorable large triggers, well, then you know that you had that trade that you're looking for. You know you had the best of the best. And the cool thing is notice how close the top of the bar is to trouble. And I want you newer users to pay attention to this. We have 5 ticks to get to problems, 4 ticks to get to problems. That's $40 worth of profit if you jump in at the top. But if you wait for the pullback, excuse me, you wait for the pullback to the area inside of favorable large triggers, you've gone from $40 to $250. We increase profit potential by buying low. We increase profit potential by waiting for the pullback, by getting in at the best of the best spot. But it's a two-chart process. Strong triggers, clear path, then and only then do I look for my small chart. Small chart, give me a reversal. Identify the highest point of support to the lowest point of support inside of favorable large triggers. Guys, look where the market bounced and look where it went with all the momentum. This is what we're doing right now is we're defining the entry, getting in at the right spot. And if you're on simulator, guys, every time you think you see a trade, I want you pulling the trigger and writing the rules. Learn to police yourself a little bit, and I'll police you as well. And then here's your first management lesson. We've defined entries, right? We have the advantages, we get into the market, and now we've got to do something with that trade. Well, your initial stops are placed where the market shouldn't go. Embrace that phrase, where the market shouldn't go. 4 or 5 ticks above the window of opportunity. 4 or 5 ticks below the window of opportunity, guys. This is where your initial stop goes, because if the market blows beyond that continuation point, if the market has all the giddy up and the small crowds got it in them to push all the way up here or all the way down here, well, we don't want to be in that trade anymore. Now we're on the wrong side of everything. We've exceeded our correction point. We're beyond all the areas that were supposed to create a bounce, and it's no longer our trade, and you will get stopped out, and you will take losses. Kenny, you will take losses. Arnie, you're going to lose trades. David H., you're not going to win them all, brother. But that's okay. It's a normal part of a positive equity curve. It's a cost of doing business. Because anything that wins 70 to 80% of the time is mathematically obligated to lose 20 to 30% of the time. I want you to get good at losing the right trades. And the key is eliminating the wrong trades, getting rid of those trades that are chancy, that are risky, that are hopeful. I'll take this loser all day long and they will have to come to my stop. I won't offer it up to them. And the cool thing is once the market begins to move in the direction of all the momentum in the clear path, you're going to reduce your risk about 2 ticks below the reversal bar, 2 ticks above the reversal bar. And this is going to give you the uncanny ability to reduce your losers to virtually nothing. If I get into this trade and everything is great and it's the perfect entry right above support inside of favorable large triggers, and I get the reversal bar, my stop is 2 ticks below it. And if that market decides to head back down and hit my stop, I'm out $40. I'm not out $400 based on hope. I'm not out $300 based on wishing that market would go up or praying that my trade works. The market told me we're beyond the point. Let's get the hell out and wait for the next best trade. And management is going to be a big part of what you do, guys. And there's a lot of red flags on the small chart that'll help you get out of a trade when it's time to get out. One of them is a second lower divergence. If I'm in the market and a second lower divergence prints, I'm going to get out of the market. I'm going to say, man, it may push lower. So Grant, there's one. I'm also going to use the small chart to manage. If I get into the market, second lower divergence, I'm going to exit. I'm going to take some profits. I'm going to be happy with it. But if I get another signal to get in, if it pulls back to support at the triggers and I get a reversal bar, I'll still take that trade as long as the large chart didn't change. But I'm not willing to risk the look because my goal is to get paid. I'm in the short, one divergence prints, doesn't scare me, market pushes back down, second higher divergence, I'm going to get out, I'm not going to lose any money, and I never get another signal, so I don't take that next loser. Guys, this is just management. This is all in the slideshow that I'm giving you. I gave it to you at the beginning of the day. I'm going to drop it in here one more time for you. So as you begin to work on management, study these. If I'm long and I hit yellow 1-to-1s, that's a great place to take half your profits. If divergence prints, there's your exit. Guys, management's hard. Well, it's not hard. Management is going to take more thought. Management is going to take chart reading. Management, really, to be honest with you, is the second piece of the puzzle. Great entries are what we're striving for in the beginning. Whoops. And the easiest way to catch great entries is to have a plan. Rob, connections. Your Ninja Trader is trade live money. Simulation is when we practice on sim. Well, Ninja Trader is just the platform. Ninja Trader is like your Atari 2600, right? And you're going to either play Galaga or you're going to play Space Invaders. So all Ninja Trader does for you is it gives you an arena to read your indicators. You'll set your account to either simulator, which means that it's not real money. It's just a practice account. That's all you're doing. Or if you have something like Apex or a live account, then, and it even tells you to get off of simulation mode, I'm not going to do it, you can switch to a live account. But yes, you have to pick between the two. Sim is laser tag. I like that, Gary. Sim is laser tag and live is real ammo. So guys, I'm going to give you the KISS plan right now, and this KISS plan does a lot for you, and we're going to go through it. This is a stepping stone. This is a stepping stone, but this is also a fallback point, if you will. This is a restoration point on your computer if you're struggling, if you're not getting to where you want to be. Maybe you're not catching the trades you want to catch. Maybe you find yourself looking for too much and catching nothing. So this KISS plan is designed to be a stepping stone, guys. It's also designed to be a fallback point because what it does is it optimizes your chances of success with the high probability trend trade and the 50-50 trade, that medium probability area likely to break, potential to break. But it's going to be through simulation, through study. It's going to be through the class feedback. And I think that's one of the biggest things because I sit over here in front of my desk and I have no emotional attachment to your trades. I have absolutely no fear of you winning or losing. The only thing that I can do is look at what you present me and give you feedback and tell you what I see. And guys, I'm a pretty good chart reader. And then you're going to practice. But that feedback's, I'm going to recognize patterns in you. Everybody has a thing. I'll recognize your thing, and then we'll work together to fix it. But your simple plan for consistency, never fight the large chart. Can't stress this enough, guys. Let the large chart lead the way. You're going to be tempted to take an entry because the small chart said go, but if the large chart didn't, hey, what's up, Ace? Good to see you, man. Let the large chart lead. And this is just a little tongue-in-cheek, and if anybody finds it offensive, I apologize. How to Commit Financial Suicide in One Easy Step by John Novak. Chapter 1, Trading Against Strong Triggers. Chapter 2, Trading in Determination Conditions. Guys, this is a tongue-in-cheek little joke book put together, but guess what the two biggest mistakes new users make? And this was put because it's funny, so your brain's like, haha, that's funny, but you're going to think about it before you take a trade, guys. Don't fight triggers. Don't trade in determination conditions. Define your entry. Gino thought I was giving him a little grief this morning saying you got to trade your plan. You're going to see people with more experience than you taking trades that don't make sense. You're going to see people that have done a little more study than you, that have more experience than you, that have other charts on not in view. And they're going to take trades that you want to take because you're going to see them winning. And guys, I'm telling you, they're taking them because they're chart readers. So focus on your plan first. Focus on your entries first. You'll get to your point of growth. And that's going to happen through simulation, study, class feedback, and practice. And then you're going to create your own plan based on your ability to read the indicators. But we start with the highest probability entry ever, goes, because what it does is it allows you to manage. It gives you the highest chance of success. It creates confidence through the memory of success. And then you have to manage the trade. You have to do something with that great entry. And management takes chart reading. And remember, you're just now starting to learn to be a chart reader. It doesn't make any sense at all to put the pressure on yourself to manage appropriately or aggressively or conservatively or consistently if you're still learning to read your charts. So what we found is the most mechanical approach ever is the easiest for the brand new user, and you will create a management plan based on your ability to read the charts. But if you allow your management plan, and the key to your management plan to be, I enter where the market is most likely to continue. And guys, 5 minutes till Fed Powell speaks. 5 minutes till high impact news. If I enter where the market is likely to continue, I know where it shouldn't go, and that's where my stop goes. Either gets hit or it doesn't, guys. I'm not in control of that. With all that momentum and a clear path, I am more likely to get a reversal bar in the direction of the trade. So my new stop goes 2 ticks above it, and I'm not going to do anything else after that. I'm not going to start watching fluctuations on a small chart. I'm not going to start panic moving or jumping out or whatever. I'm just going to sit and wait and see if it gets hit. I like it. I'd love a snow cone. And if it doesn't get hit and it hits the first target, you're $100 richer, you're a little more confident, life feels good, and you have zero risk on the trade. You've gone break even. Break even's going to get hit a lot, guys. We saw it happen twice yesterday, I think. But if it doesn't get hit and it goes to the second target, which is a small $200 away, guys, you're $300 richer for your efforts. And I'm telling you right now, $300 a trade doesn't suck. $300 a trade is a pretty outstanding amount, because if you're taking a trade that typically wins 70 to 80% of the time, you find 4 of these trades and you lose 1, you're up $600 or $700 on the day easily. And $500 a day is like $125,000 a year, guys. So this management is in the spreadsheet. The management's right there. And the reason you have to know what kind of trade you're taking, the reason you have to understand if you're getting into a high probability scenario or a medium probability scenario is because every trade is going to take a different form of management. So the easier you keep it in the beginning, the easier it'll be to manage your trades, guys. And that is my first hour. So I'm going to give you the KISS plan in the room. I may have already done it. I'm going to give it to you again. Download it, study it, ask questions about it. I'm also going to give you a high probability trend trade checklist, guys. And this checklist is designed for you to print out and put on your desktop. And every time you're looking to take a trade, make sure you're following the rules. And then I'm also going to give you a high probability trend trade with pictures of everything that we just talked about, reminding you how to get into a trade and what it looks like when you get into the trade. And then the only thing to do from there, ladies and gentlemen, is to take so many stinking pictures that your picture finger hurts. Let's watch the NASDAQ when news hits. Wow, but look at that. Odds favorable, down, pull back to resistance right inside of favorable large triggers. I'll be damned. Look at that. Termination, weak triggers. Look at the bounce. Large triggers didn't follow. Is it just me, or do we just talk about all this stuff? Momentum for the win. Beautiful trade. I'm not sure if anyone caught that this close to news. If you didn't, it's okay. But 2 charts, guys. 2 charts are telling me everything that I need to know. We have news in about a minute. And we'll just go large chart. We'll see if it gets a little crazy. I'm going to take 5 minutes when news is coming out. When I come back, we're going to start looking at the pictures that you guys posted. I want you to take whatever you heard in this first hour, and if you have a question about it, I want you to drop it in the room. And I want you to ask me, and I want you to point it out in pictures, and I want to talk about what you're looking at so that we can get you to that next level. When I come back, we're going to talk about advantages on your trades. We're going to talk about the chart read, and whether it's a high probability trend trade, a momentum trade, whatever kind of trade it is, we're going to use the advantages. We're going to talk about the advantages, and hopefully, hopefully, you guys wrote your rules on the chart. You guys are telling me why you did what you did. You guys are telling me why you got into a trade. Because the whole idea, guys, I can read your charts, but if you go back tomorrow and all you do is look at pictures and you have no freaking idea what you were thinking, how is that going to help you with the study process? How's that going to help you recognize problems or advantages? Annotate your charts. Please, for the love of fuzzy, annotate your charts. That's a termination condition, and here comes news, guys. I'll see you in 5 minutes. you doing, sweet girl?
How you doing? It's so nice to see you. Did you get your belly full?
Did you get your belly full? Did you eat? You sure did. You sure did. Nice job. Strawberry, sweetheart? Do you want strawberry? Yeah. Well, that wasn't too crazy, but how are we feeling about termination conditions, guys? How are we feeling about areas likely to stop the market? When price reaches Fibonacci support and none of the trigger lines break, am I a little off base in saying you should take a minute to learn these because they sure do pay dividends? All right, so that's our first hour. Notice that the larger above, the smaller below, the larger flat, the smaller weak. The synthetics are up, the larger down. Man, that's a lot of indecision. Let's wait and see what they do. Let's see if they give us odds favorable. Let's see if they give us a clear path. That one didn't, but that was a pullback to support right before it hit it. And now I pulled up the RTY. I'm kind of digging this one. Bad top, mid band, triggers don't follow. We're in a decision-making point. Are they going to continue up? Or is this going to be that weak triggers termination that reverses the market? The reality is, I just don't know. So I'm going to scroll up to the top of the room, guys, and let's see if we can come up with some pretty good lessons here. Dun, dun, dun. Joel got us going last night at about 8:45. Just a reminder, if you post pictures at night, you're doing market replay, whatever, I'm more than happy to look at them the next day. You don't have to be sitting live in front of the market to get feedback, guys. Joel says that I had strong triggers. He also had a 50-50 look, the larger below, but the smaller above. The momentum is the best look ever. He has strong triggers, a tiny window of opportunity, and he takes the trade. He gets out at the first trouble spot. Joel, I absolutely love this. And guys, here's the challenge, and I think we saw this one on a trade that's coming up next as well. One divergence on a 50-50 trade is problematic. Two divergences is typically the kiss of death. So when you see that two divergences on a 50-50, guys, you can get out a lot sooner and you can manage. And this is why you have to know what kind of trade you're getting into. And look at, Joel came back after and he said, manage closely, divergence on the 13.2. It's a bad bottom. So you have to go through some of these to be able to manage it real time. And it takes a while. So understanding what kind of trade you're getting into pays dividends on what you're doing with it. Once again, bad top, 50-50 trade, right? I've got large triggers above the areas. I've got small triggers below. And then you had a limit order waiting. One divergence on a 50-50 can be problematic. Let's go to the next slide. Two divergences on a 50-50 can kill it. And that's one of those things where it's hard to find a reason to get in. Two divergences on a 50-50 is a trade killer, especially from a bad top. Does that make sense, Gino? Understanding what kind of trade you're getting into has you looking for conditions to be met. So bad top, not a termination that creates the full reversal, 50-50. For me, two divergences is a 100% no-go. One divergence I might take a shot at. Two divergences, I'm cool just letting it happen. And then here's a pretty good example of, and this may not be what you had going on, but for me, Gino, this is the pride trade. I was so convinced that that market was supposed to go down that I took one more short. Even though it was still two divergences on a 50-50, I took that short anyway because to hell with the market. They don't get to tell me that my read is wrong. Man, I've taken that one so many times, Gino. I can't even express how many. And then what happens, and this is the same one, is another area that doesn't hold during low liquidity. I don't think it has anything to do with the liquidity, Gino. There's an awful lot of people trading NASDAQ pre-market. I mean, there is an awful lot. But that makes us feel better, doesn't it? So let's go take a look. That's a termination, right? That's a 50-50. This is split triggers. And that's your window. So what you have to ask yourself is do I have more advantages than disadvantages? I trade pre-market every day. And 90% of the time, I think the trades do what they're supposed to do. Maybe 80% of the time. So what happens on this one is instead of creating the opinion that this is another area that doesn't hold during low liquidity hours, and I put the picture in behind it because I love that you did that one. And I'm going to show you my read on it. And granted, I have a little more experience, so my read may come through a little more advanced, but here's the exact same read. So the bad top. And the bad top means that this market has the potential to continue up. So from my bad top, I hit the mid-band. The mid-band holds. Large triggers are a full bar away. So the mid-band is a termination. So that means that I'm at a termination and the market's going up. I'm coming from a good bottom. Bad top, back to the mid-band. My small triggers are absolutely screaming and they're above support. And then, Gino, you're absolutely right. Split triggers, big window, not the best look. But if you're patient and you let the market do what it's going to do and you get your entry on the correct side of the smalls, that's a little NASDAQ thing, it becomes pretty easy to make that $300. So my brother has this loving phrase where he says, back the F up and look at your large chart. And I'm not sure if this is how you keep your large chart when you're trading, but check it out. The only thing I can see on the large chart is trouble. But down here, I've got strong bottoms. I've got reversals. I've got mid bands that held. I've got all these wonderful things going on down here, but you're only looking at the bad up top. So, and there's that bigger picture, right? There's that termination that created the full reversal to a bad top. Mid-band holds, large triggers a full bar away. We're expecting more up because of the termination. And that's kind of the larger chart read. There's RTY right there. Split triggers. Is it going to go from here, from here, from here, from here? That's the hard one. That's what's difficult. And then CAV, NASDAQ went directly to support to the tick. And that's what took it from going to the seller. So I guess 17,964 is the seller of the NASDAQ. And then from the good bottom, it pushes all the way up, 50-50. It's ugly. Back to support. Large triggers don't roll. And now we're weak triggers into resistance. And there's your bounce. And I need to reload historical data because all that movement got my triggers wonky. Gino, I hope that makes sense a little bit. And just for everybody, make sure you can see where you're coming from, where you're going. It's going to help a lot. And then Grant, same idea. This was the long that I took. And you're saying, I'm not sure if this is a good buy setup. And I hope you're in here. And once again, I'm going to play my broken record card, guys. There's 3 rules that we talked about for the high probability trend trade. And the first one is odds favorable momentum. So Grant, we can both agree that you have odds favorable momentum, right? Strong triggers, you wrote it on there. Strong, small, large. I'm not sure what a buy chart is, but we've got strength. What don't we have? So this is a termination condition. So I don't have a clear path. So if I go back to that cool little slide chart, I have momentum. I don't have a clear path. Let's see if I have an entry area. Let's see if we can turn this into a medium probability trade. Well, I've got split triggers, but I've got a mid band right inside of the synthetics. So I've got strong triggers. I'm coming from a termination condition. I don't have a clear path, but I've got a very clearly defined entry area. Are you with me so far, Grant? I've got 2 out of 3. It's a medium probability trade, which means since it's the NASDAQ, I probably want to get on the correct side of these small triggers because these small triggers ruin the party more often than they don't. But if I get in on the correct side, I know where my trouble is. And if I get a second lower divergence, I manage out of the trade. Does that make sense, Grant? Understanding that the path isn't clear puts your management hat on. Trading the NASDAQ keeps you from fighting the small triggers. I love everything about the read, and if I'm not mistaken, my brother got long somewhere right about there. Woo! Guys, they're still going on the NASDAQ. Do you guys see that move? Termination. Man. Good thing you guys knew about that, huh? Kept you out of trouble. Grant, it's a great trade. You just have to put your management hat on if you take it. And that's why I encourage you guys, the fewer trades you take, the easier they become to manage because you're not wondering what kind of trade it is. If you only have 2 options, you've only got 2 management plans. And then Gino, that's that acceleration. We looked at it earlier, and this is another one where you have to kind of take everything into account. The market's been trending up. All the triggers are above problems. It's pulling right back to support with every trigger above it. And those triggers are in a momentum. They're starting the momentum. So if you wanted to take a shot at this one with a reversal bar, it's a pretty good look. It's not high probability yet, but it's a pretty good look. And that's just understanding that the trigger lines, when they begin to accelerate, they're moving from right to left. And when they're decelerating, they're moving from left to right, is the easiest way to put it for long trades. All right, guys, I'm scrolling through. I'm trying to make sure I don't miss anybody. If I ever miss a picture, let me know. All right. Cav, what makes this a good bottom? I need your definition here. My definition says definitely not a good bottom. My definition says that if it's not a no triggers through termination condition, that is a very weak bottom. That's not the kind of thing. Triggers didn't break what? This blue fib? I just have to be sure. I want to know where your brain is on this one. But price never reached the fib, right? So it's not a termination because price never reached it. And I think this is where language once again becomes important. And let me see if I can do this. If you were looking at this chart right here, is there any reason you wouldn't go short right there? No, for it to be called a termination condition, Cav. In order for a termination to happen, and this is why I love it when you guys ask questions. In order for a termination condition to happen, price has to reach the area. That's what makes decisions happen. Price comes down, hits the area, that's your termination. If it doesn't hit the area, well, it's likely to keep pushing. If it doesn't hit, that's not a good top, but that's a solid bottom because it's a termination. And granted, that's in news. See how the triggers are passed? Boom, boom. So the idea of termination conditions, or of strong tops and bottoms, and let me go to a picture. And I'm so glad that you put that because I really think that this is a pretty solid lesson. The idea is that price reaches, no triggers through, then it's a termination condition. And a good top or bottom can only be a good top or bottom if it's a termination condition first. Does that make sense? And then once it reverses, it becomes a good top or bottom. So that's a termination condition. Once it reverses, it's a good top. Pivot stop out, no triggers through, that's a termination condition. Once it reverses, it's a good bottom. Does that make sense? Awesome. So right now, termination condition. If this reverses the market, it will become a good top. Awesome. Thank you for posting that. And then let's get into the rest of the trade. Sorry, we turned that into a lesson, right? But that doesn't discount the fact that you have unbelievable momentum. It doesn't discount the fact that the smalls broke through, that you let them break through, and you took that little pullback right up to the fibs with all that momentum. So that's a completely different lesson than what we are looking at in your trade, because your trade is outstanding momentum, and your trade is letting the small triggers get through the area to take that momentum style, right? And that trade is coming right from an area, and your trade is an absolute thing of beauty. And the lesson over here is just a little sidebar. Has nothing to do with how beautiful your trade is. I will always celebrate victories, guys, but I'll look for the opportunity on the chart reads. And then that's perfect. Weak top. Beautiful. But it's still the best momentum ever. Bounce off the blue fib back to the trigger with the mid band. Place the limiter at 091. And you got both targets. Isn't that outstanding? It is a weak top. But it's the best momentum ever with the potential to break. And notice that you didn't have divergence here. And look at the strength on both charts. Guys, momentum for the win. Momentum for the win. I want you to put that on a coffee mug or a t-shirt or something. Momentum for the win. And then when you can pinpoint and sell high, great things happen. Absolutely beautiful, Cab. You are killing it today trading with momentum. Cav has given you guys the best lessons you can ever get today. Momentum moves the market. Momentum makes things continue. Momentum, it's just sexy. All right. Let's take a look at what you did. Trying to see where you got in. Your charts are tough to read sometimes, Gino. All right. I need to line these up. You blew out pre-market. I'm sorry. Enter at the area between triggers. Hit one target, got stopped out on another. All right. So we're in off the bottom here. Is that right? 73, 73, Smalls are returning to the large. You've got one line in, so it is a loss of momentum. You don't have to, Cav, but I think it pays dividends. Let me go through Gino's chart, and then I'm going to address that. I'm gonna try and say it a different way. So Gino, still momentum, but not the best momentum, right? Not big separation. One line in. It's still a good look. It's still strong. But what is the small chart starting to tell you? The small chart tells you, well, we're losing momentum, small inside of the large. You still take the most beautiful entry ever. And man, there's got to be a willingness to fall on your own sword, if you will. You're in at 83, and this is the NASDAQ, and the NASDAQ moves, and NASDAQ's a different animal, right? So when you get in here, it's probably going to push up. Look at your small triggers absolutely screaming against it. It's probably going to push up. And then once it pushes up, you survive all of that. And then it begins to come back down. And I guess maybe it got you break even, 83, 83.05. I'm not sure where you exited, but it's a good look, man. It's a great trade. You made 100. So you were able to get in and hit awesome profits on 3 contracts right there. That's pretty insane that you can do that on the NASDAQ. If you were in at 83 and out at 78, 75, that's 80, that's 160, and then another 30. So that's almost $200 worth of profit on the bar that you entered. That's pretty cool. Nice one, Gino. They don't all run, do they? Look at that. Support, large triggers a full bar away. I wonder how many times we're going to see that look today. Tony the Tiger. Momentum is down. Looks good. You jump in at the bottom, and then it pulls back, and Tony's like, I know where it's going. I'm going to add on. I love this, Tony. Man, if you can virtually high-five yourself real quick, I want you to. Guys, I want you to see what Tony did. As Tony makes money, and then he re-enters on a momentum look, and this is a great momentum look. Everything's screaming down. And when it starts to pull back, Tony doesn't panic. Tony says, check it out. I've got areas inside of favorable large triggers, and my rules are met for a trend trade. Let me put my stop where the market shouldn't go, and I'll add on some contracts. Man, Tony, that is heads up trading. All right. Cav, are you ready to get the lesson on why strong tops and bottoms are important? All right, so, and we'll just use, gosh, the market's been pretty insane already. So Cav, the sellers were in control all the way down. Would you agree? They're in control, they're in control, they're in control, and they reach a decision-making point, literally to the tick. They reach Fibonacci support, and none of the triggers break. When it creates the reversal, this is a good bottom. Let me take the picture of it, and I'm going to see if we can do a better good bottom or top picture. So this is a good bottom. What does this mean? A good bottom means that the sellers reach their target, or the buyers have decided it's time to go the other way. So what does this mean? This means decisions were made, Cav. Right here at this area, decisions were made. And the decisions were sellers don't get to win anymore, buyers get to. So when you get a termination that creates a full reversal, it's coming from a key area, man, there's people that just had automatic targets right there. And there's people that had trade entries just waiting at this point. And when John was creating the algorithm for the software, he had a buddy in Chicago whose only job was to know where the institutions had buys and sells, and he couldn't tell John those. But John got to the point to where he was typically within 50 cents, and that's when he released, and that's really when Nexgen started. So when a termination creates a full reversal, it lets you know that the decision was made by the powers that be, that now it's time to go up. And then the flip side, the buyers are able to push it all the way through, right? The triggers come through. And this is a bad top. And what does that mean? That means that the buyers could push past the decision-making area. So they either still want to go up, or there were just no sellers wanting to go down at the fib. All right, so decisions made, sellers exit, buyers enter, take over. They're able to push through. This is that 50-50 look, right? Potential to break. Well, they don't get to the next area. They clear the previous area. They're in limbo here. It's a bad top. There's no decision-making points where the market reverses. And that's what I want you to get out of it. There's no decision-making points. There's no fib. There's no one-to-one. There's no decision-making points. The market just went down. But look what it does. It comes back to the next supporter line of defense. And then the buyers take it all the way up to that key Fibonacci, that one-to-one alternate, right? And decisions are made. And decisions are made. And the sellers go, but we want it to go down. And they get right to that line in the sand where the buyers stole their momentum last time. And decisions are made. And the buyers say, ha, we stopped you out, pivot stop out. And now we want it to go up. And sure enough, they go all the way to the key area. And with the momentum, they absolutely smash through it. So when decisions are made at key areas, look at that. When decisions are made at key areas, the market's more likely to push the other direction. It doesn't guarantee it, but look at this right here. The buyers hit it, and the sellers push all the way down to support, and some of the buyers forgot to take profits. There's that pivot stop out. And the sellers take over right to the buyer's next line of defense. The buyers test the waters and they push. The sellers say, no, we want it to go down. Weak triggers at support, termination, divergence. The buyers say, to hell with you. We really want it to go up. So key areas are fighting points, guys. Key areas are where the people that control the market, not us, are making decisions. So when the market reverses from a key area, there's strength in that reversal. When the market does not reverse from a key area, well, then that market may continue the next, to the next direction. And you'll see it sometimes. The triggers get through a little bit, but on the second testing, they don't get anywhere near. And it just kind of works out. Does that make sense, everybody? I hope that's about as elaborate as I can get on it. And I hope that it was helpful to you. Miss Cindy says, Mark, I don't annotate charts. Not a strong top, Miss Cindy. Did the lesson that we just did help with that? Not a strong top. They got past all the decision making. Okay means I don't know, Mark, but I don't want you to call on me in front of God and everybody. Not from a decision making point. And that's okay, because you still had incredible momentum. The sellers clearly wanted to go. It's just not a strong top. Look at that momentum smashing through, pulling back. Absolutely beautiful. It's the NASDAQ. So you give it a little breathing room, because this much momentum on the NASDAQ tends to push. And you'll notice that it dances right at the key area. And Cindy says, I love me some momentum, and takes it down here. And Cindy, I love everything about this trade. That is a beautiful trade. And it cracks me up that you'll pick one thing to annotate on a chart just hoping that it shuts me up. I love it. Great job on that one. Momentum for the win again, guys. Gino, strong upside, got smoked. Why did you get smoked, brother? I can't see what's coming on your large chart or on your small chart. Oh, hey, Adriana. Man, that's trouble. We have both of you in the same room? Uh-oh. Look out, Miami. All right, Gino, that was 952. I'm going to scroll back to 952, and we're going to see what happened there. It's ha-ha, Rob. In Spanish, J makes an H sound. So if you have Spanish-speaking friends, they will literally put ja, 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 ja. And what's funny is I hear it ja, 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 not ha, 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 ha. All right, 952. Gino, I want you to see. There you go. And guys, I want you to see this. And I'm going to make it a little visually more. And Gino, I'm not sure if you're still in here. You get real quiet when I talk about your charts. I love the termination. That's a good look, right? That's a good look. Dig it. I like the momentum. That's a good look. And then Gino, price reaches a midband. Large triggers are a full bar away. Price reaches a midband. Large triggers are a full bar away. So one of the things that happened here is we traded right into a termination condition. Do you see it? So if nothing else, it's going to keep you a little patient and waiting for the pullback. Aha, but there's more. Large triggers are below all of the areas. Small triggers are above, but the large triggers are below. So it's 50-50, right? And then we get that 50-50. There's divergence, and we know that jacks up a 50-50. And watch this, from the top of your triggers, whoops. From the top of your triggers to the bottom of your triggers, the only line that's even remotely close to being inside is that one right there, all the way down. Yes, Rob, you are fluent, my friend. Do you see that, Gino? So we're just going to piece it together a little bit, and this is why I love to see the whole chart. The momentum looked good, absolutely. And if you took a little momentum style trade here, it might have worked up to the mid-band. But once you get to the mid-band and the large triggers are a full bar away, that's the gap theory. And it's like a big sucking noise down to the large. Not a bi-sucking noise. There you go. And it literally just, it pulls it all the way back to the synthetics. And these split triggers over here in divergence, if nothing else, it keeps you focused on the synthetics right here. And it says, man, this is probably, if it's going to continue up from this great stop or this great bottom, that's an awesome spot for it to happen. But you'll notice that when you get down there, there's that NASDAQ characteristic of crazy strong small triggers. So Gino, I'm not teaching you how to get into a trade, but I'm teaching you how to incorporate just a couple basic concepts to keep you out of a trade. Because what happens is when you can do this read at a moment's notice, and this takes practice, guys, what it does is it has you saying to yourself, okay, no trades until it hits the synthetic. And then once it hits the synthetic, you say, all right, no entries yet because my small triggers are so strong against me. And then if you were still convinced that the market was going up, a close on the correct side was still short-lived. You still got wiped out because at this point, it's just there's so much, everything's changing. Does that make sense? I think that your picture was pretty awesome. I think that the read, based on the good bottom, had you thinking the correct direction. There were just a couple factors in there. And these split triggers, man, where's it going to happen? And these super strong triggers, I can't fight those. And NASDAQ traders, we talked about it yesterday. I'm going to talk about it again today. Look at that. Odds favorable, clear path, right off support. Your large chart on the NASDAQ, ladies and gentlemen, is a 34.5. It is not a 13.2. So we did this yesterday, and I asked the question. Let me see if I can find it. Is anybody going short against these small triggers on the large chart? Is there anyone in the room that's like, man, those are freaking strong. I better go short. This is going to save you NASDAQ traders. These small triggers on RTY are these small triggers on NASDAQ. That is all messed up. And these are a huge time frame. So those small triggers on the NASDAQ, guys, these are your large chart triggers on any other market. And fighting them rarely works. Because what do I have right here? I have odds favorable momentum to the downside. The same that would get you into a short trade on a large chart. Does that make sense? I hope. That's a pretty good lesson for you NASDAQ guys. And then Rob. Whoops. I just reported your message, Rob. I apologize. I didn't mean to. If they give you any grief, have them come to me. On the 13.2, we have triggers headed down wide, getting wider, tails formed. Look to the 5-1 chart. I see a pullback in favorable large triggers right above Fibonacci resistance, 702, 702. Hey, Rob, perfect. Absolutely perfect. Nice job. Large chart, down, strength. Small chart, sell high. I love it. It's all coming together, brother. It's all coming together. All right. Grant, place stop loss just below the fib support. You got in after the tail created. I'm going to encourage you guys to not try to trade the tails on the large chart. This is too slow, guys. It's too slow. If you want to get long, your long is from support inside of triggers. That's it. That's your best spot. That's the least amount of risk. That's the most amount of profit. And then once you get into the area, right, it's trade over. So Grant, your trade was from support. And it reduces your risk dramatically. Does that make... If you're going to take this trade, buy low. If you're waiting for tails to form, man, it's gone. You're in at 64. Third bar confirmation. That's a lot of confirmation for strong triggers and a clear path. Wouldn't you agree? And I don't know if that's a rule that you've created for yourself. If it is, that's great. I'll recognize it now. But 1, 2, 3, 4, 5, 6. Your third bar confirmation got you in on the 6th bar. And that's just me using my counting skills. That's about as high as they go. So when you've got momentum, when the path is clear, take the pullback to support. Reduce that risk, increase that profit potential. Does that make sense? So how do you stop that? What would be too soon? Too soon would be the top of the triggers, right? Just right would be Fibonacci support. Your stop would have kept you safe. But too soon and too late, and you'll, oops, I'm going to go to this picture. I know exactly which picture I want to use real quick. And we're going to go through just a little lesson on this. And I'm going to show you a lot of the common things that happen with new users, Grant. So I don't want you to feel like you're on the wrong side of anything. But the key to everything is when the rules are met. If high probability trend trade rules are true, hesitation only costs you money. That's it. So the idea is that when the rules are true and you get your reversal bar, and this is the key, you've got to go through that process. Because the rules are true, because I have momentum, because I have a clear path, this is where the market is most likely to continue. Does that make sense? And right now, Grant, you don't trust it. You don't trust the idea that this is where the market is most likely to continue, and that's okay. And then what I see is I see people watch the market come down, and this is where you're like, is it really a trade? Is it not a trade? I think it's a trade. Maybe it's not a trade. Are my rules really met? Shoot, I'm not sure. And it hits the top of the triggers and starts to go up. And this is the most common entry that I see. Is this one where it didn't get your entry, but the market started to go up and people get suckered into the little fluctuations on the small chart. But what happens is your stop still has to go down here. So your risk is huge. And your target isn't very far away. And you have to sweat out all of this nonsense. Does that make sense? That's the first one. And then what you're doing is when the market reaches the area, that brain of yours is saying, but what if this trade doesn't work? And that's all your brain is doing, right? You have it keeps going against you a lot of the time. But Grant, if I look at your charts and I look at what you post, I'm going to show you one of the factors that may be contributing to that. Because one of the things that I'm really good at is recognizing patterns in people. And when you take trend trades, Grant, hold on, I'm getting to it right now. Let me see if that was it. That wasn't it. I've noticed a pattern in you taking trend trades. Where on earth is that one? It's a beautiful trade. But you're not afraid to trade into a fib. And I can't find the one that was in question. And if you're trading into a fib, then you're more likely to get run over. But you are so good at identifying momentum that I've seen you take trades into the fib, which pulls it out of the high probability scenario. Does that make sense? And I'm trying to find like an example of where you did it. You love this look because the momentum is overwhelming, right? But it's into a termination, and a lot of people, and you're not the only one that does it, says, hell yeah, I'll take this trade. And then when it loses, you're like, man. And if you're not annotating the chart that it was directly into a termination condition, well, then you may not be catching that. You may not recognize that that's one of your patterns. I recognize the pattern because that was my pattern. So what you're doing is you've got to develop that trust, and you've got to let the large chart be right. When the large chart is perfect, Grant, use the area inside of triggers. When the large chart isn't perfect, maybe you do have a little challenge there. Maybe there is a fib right here. Doesn't it make sense to get in low to give yourself the most room to manage? Doesn't it make sense to get in low to give you the absolute least amount of risk on the trade, rather than getting in up here where your profit potential is decreased dramatically, but your risk still has to be all the way down here? And a lot of people do. And that's why I say every day, let the large chart lead the way. That's why that's my battle cry each and every day, is you've got to let the large chart lead the way. Because if you're trading the small chart first, let's see if we can find a great example. If you're trading the small chart first, if you're trading, that's not really any good examples. If all you're doing is looking at this area and you're not looking at the second lower divergence, right? There's the first bounce, there's the management opportunity. So the small chart gets you the entry and the management. And then we get into, on the NASDAQ, a 50-50. Split triggers, it goes to the higher trigger, and it does in fact continue down. And then divergence on a 50-50 from a bad top, you've got to get out of that trade. So if you know what you're up against on the large chart, if you know that it's 50-50, if you know that divergence can kill that, then a small chart entry doesn't fool you. You've got the advantages here. Does that make sense? I hope that makes sense. I'm asking if it makes sense a lot. There's a lot of you guys that are right on the cusp where you're taking beautiful trades, and then management and a little better entry is going to help out a lot. And then Rob, perfect again. Strong triggers, circle the tail, area of support. It's so hard to argue with momentum and a pullback to support. And then Rob, same trade, so nice you post it twice. Triggers are wide down, momentum is good. 1210. Nope, so we're back here. A little weaker, Rob. No, if that's the one, you're breaking through, there's still momentum. You've got one spot where it's most likely to go, and it goes. I like it. So Grant, just write it on a piece of paper. Large chart leads, not the small. Read left to right. I literally have that on a piece of paper in front of me that says large chart leads the way, because one of the tools that I use, Grant, is this range chart. And if I let this range chart lead the way, I get slaughtered. But if I remember to let the large chart lead the way, my day goes pretty effortless. So just like Rob's showing here, when everything is down and strong, it's pretty easy. When the path is clear, it's pretty easy. And then every one of the advantages that you give up, you begin to create a little more difficult scenario. You need a little different management, all that good stuff. All right, Ace J got in and sold early due to fear. I love your entry. Are these lining up? No, these are two different trades though. Let me figure out. This one is at 634. Nope, this is the same trade. Ace J, this is solid, brother. Everything is up. The path is clear. 79.20. I'm trying to line it up. This chart says you got in at support down here. This chart says you got in up here in the middle of the move. Which is right, Ace? Is he in here? I'm scanning. He may not be in here anymore. And that should have been the target. I agree 100%. That was the entry. And then that was the target up there. That's odd how they don't line up though. Large triggers were above the small, so I thought it would reverse. Guys, that's the most damaging phrase in day trading. I thought. Change that. Swap it out with indicator said. Paul, let me figure out where we're at. 10:01, trading directly into news. Strong triggers, clear path. Pull back to support inside of triggers, and you make easy money up to the fib. Nicely done, Paul. Momentum for the win. I wonder how many times I can say that today. Momentum for the win. I can't say it on this one. How about termination condition for the win, Ron? Not a trend trade, but when divergence prints from a fib, you're going to take it, and you're going to take it up to the treble. I love this trade. I think weak triggers makes me feel better about it. Termination condition, triggers not even close, makes me feel better about it. I know you've put a lot of study into this trade. I love this look. I love this look. Somebody did. Somebody came in and took almost the, I think it was Cav, took the exact same trade yesterday. And at first I was like, Cav's fighting triggers. And then we went through the logic on it. And everybody was like, holy crap, Cav's pretty smart. That was a great trade. All right, who is this? This is Gary. Trying to figure out. Let me line it up. You guys make it difficult for me. I see I see a termination, back to support, large triggers didn't follow, back to support, close on the correct side, back to support, correct side of your fast triggers, and sure enough, it goes right up to resistance. Gary, nice job. Great patience on letting it get down to the area too. Not a high probability trend trade, guys. Taking advantage of termination conditions. All right, Dwight. He is level 33 of the trade shrine. I love it. All right, so Dwight, your first entry, you just jumped in, hit a mid-band with the large triggers a full bar away and made a couple ticks. You had your entry 2 ticks above the mid-band. Since a double divergence, you canceled the order. You'll place another order if price clears magenta line on 5-1. That's fair. What if, just hypothetically, Dwight, what if divergence doesn't print on the 5-1 and it pulls back to a mid-band inside of favorable large triggers with everything up and clear here? It's a big window. The window goes from 03.25 up to 0550. Nope, up to 0750. See how the triggers are split? Where do you enter on that one? That's where, even if I get a second divergence, I'm not writing this trade off yet because it's the termination that created the reversal. Remember, the decision was made at a key area. What did it end up doing? I don't have an S&P chart. Show me the aftermath. Let's analyze the aftermath. I think you guys will find that if you go back and look at the trades that you don't take, see what they did. Strong top, you better believe it is. Momentum, darn right. No divergence, strong triggers, beautiful pullback. Cindy for the home run. Ja, 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 indeed. Absolutely beautiful. And then Cindy, did you let it break and then just move your stop right there, or was that your target? I do that all the time. With this much momentum into areas, once price breaks it, I'll put my stop on the other side, and if it decides to run, cool, I made more money. And if it decides to come back, whatever, I'm out at my target anyway. I love that trade. Beautiful, Cindy. Momentum for the win. I'm going to keep saying that until you guys believe it. Momentum for the win. Termination, everything rolls, price clears, strong triggers, get in, get out. Money, 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 money. Ron, I thought you left us for a second, but you're back. Nice job. Gary, you're making it so hard for me to read these charts. Termination, triggers down, termination, triggers down. Lower divergence, pushing down, straight into strong triggers against you, and you go long. And there was no pullback to an HVA, right? It's a short. So terminations, and you take an HVA short. Man, I got turned around, Gary. Termination, termination, second lower divergence, triggers roll, pull back to the HVA, take it down to the trouble spot. Gary, I'd like to respectfully apologize for thinking you went long. That's a beautiful short. That's an advanced short. That's a chart read short. Paul, not the best momentum, but we're coming from a termination. Smalls are up, large are up, smalls are outside of the large. There is one line inside of triggers to take this trade. Pretty easy when everything agrees, isn't it? That's that S&P trade. So, Dwight, check it out. That was the one that you didn't take. And it did pull back to support, and it did pull back to the synthetics, right? Man, split triggers are a booger, guys. And booger is a technical term to mean they really don't give any advantage. And then Joel, when everything says up with strength, why not buy support inside of favorable large triggers? Momentum for the win again. Gino. Let me blow it up. Oops. Control, shift, boom, boom, boom. Momentum for the win. Odds favorable. You're not sure if it's going to be... It's a 50-50, one divergence. Okay, so you're like, man, it's a 50-50. Let me get everything the right way. And you get in with the strong triggers. And you get out of trouble. I love it. Hey, Ron, let's get Gino a robe. Nice job, right? You're like, that's a 50-50 with divergence. I've fallen for this one before. Let me let it get right. Nice one, Gino. Momentum for the win. Medium. Medium. See, we have, who was this? This was Grant. So Grant, bad top, mid-band holds, everything rolls with tons of momentum. Entered long after the bounce off support and exited. So Grant, same lesson, right? Wouldn't it have been awesome to be in at 38? Instead of 44? And guys, let's talk about another NASDAQ feature. Let's talk about another NASDAQian pattern. Grant, large chart leads the way, right? Can't stress it enough. Large chart leads the way. Large chart tells you that it's time to look for a trade. I love your large chart read. So on the NASDAQ, when price reaches this area, your entry area, if the small triggers are more than a full bar away, same idea on the gap theory. If the smalls are a full bar away, I'm in at the area because price is likely to close the gap. And what's pretty cool is that by the time it closes the gap, a lot of times your first profits are already taken, but your risk is virtually nothing. It's easy to go break even on the pullback. And you'll see it a lot. Everything is perfect. This is the exact same trade, Grant, 100%. And when it pulls back to the area, look at the small triggers. If you get in at the area and all of this is strong, it gives you tons of room to get back. So all of that's in the spreadsheet as well. That is almost the exact same picture as the one that I just showed. Look at yours. Look at that. Doesn't that look hauntingly familiar? So you NASDAQ traders, that's a great way to reduce risk. That's a great way to build patience as well, because if the small triggers are down here, well, then being patient is really an outstanding part of it. Nice trade, Grant. And why the exit again? $80.50. Okay, 1-to-1s. Cool. Just making sure. And then Dwight. So Dwight, what are your rules for entering one of these trades? Do you jump in when you hope it's not going without you? Or does it have to clear something? And I'm asking this, you guys that take these jump in trades, do you have entry rules? Or do you just jump and pray? Which is okay. Momentum is great, right? But your small triggers are down here. Was it getting to the other side of them that did it for you? And I'm just curious. So you got above the small triggers, and you said, once I clear the small triggers at 09, I'll look for an entry. And because I don't have to make $1 million a trade, I'll take an exit. I like it. And then you could have gone long again, and it's okay that you didn't, but I like it. And I'm just curious, guys, when I see your trades and I'm not sure, I don't know what second divergence pushed it down. What second divergence pushed it down? Was there one over here? Off screen? Because there's none here. Just making sure. On the 5-1, I got you. All right, JW. Talk to me about this one, JW. You said that you had a weak bottom and a 50-50. All right, guys, let's do some chart reading. All right, it's momentum. What are your momentum rules? Just curious. Do you have rules? So my rules say, and maybe this will be helpful, my rules say that my small triggers have to break this area, and then I'll pull back to it. You did have momentum, and your smalls are eking their head, right? But they're not smashing, not yet. And we're counting on this to break 2 areas. And that one right there, I think, and you guys, if you don't agree, let me know. If I'm trading the NASDAQ, JW, that has the potential to break, without a doubt. This divergence from the pink 1-to-1s means that it's probably going to push lower. When it's this look, I got it. You're in, you're stop, you're waiting for the reversal bar. I mean, the entry is great. The stop is a little big. I like it. I just got to watch out for this one, I think. Just practicing. It fits the rules. You have momentum, potential to break. One divergence can be a deal breaker, but your window's pretty small, so you take it. I would probably have a stop up here. How did it turn out for you, man? That's the second half of it. How did it turn out? Did it go up? Did it give a second divergence? Did you have to manage it? Did it win? I can support your entry 100%. This one right here, you probably sat through an awful lot, right? It did go. From your entry here to the bottom of the bar, am I correct that you sat through 12 points? Okay, this one went up 300 and then slammed back. I'd love to see the second half of these trades. Guys, I love seeing your entries. I want to see what happened after. Management's a big part of it, and believe it or not, I can be pretty helpful with management if I see what you're doing. TLC, thank you for showing me all of this. That's going to be a key part of what we do. You guys make me laugh. How about if we turn this into a more manageable picture? It was at 825. So let's see what we had here. Potential to break. Odds favorable. Nah, you're okay, man. We're good. Odds favorable. Pull back into the triggers. Out at resistance. And you pulled back to support inside the triggers, it looks like. Am I reading that correctly? You got in at the blue line? It looks like you're in. Are you in here or are you in here? Up higher? I can't read it. It's so small. Looks like you're in at 90 something, but I can't see the others over here. I don't have any frame of reference over here. I like the exit at resistance though. And I agree 100% with the entry. It looks beautiful. It's just a little hard to read for me. The momentum is there. The area is almost broken. You take a pullback and you get out at a red line. Momentum for the win. Momentum for the win. Weak top, strong triggers. Mid-band's the first target from a weak top. We'll see how it reacts. Guys, I'm going to leave you with the NASDAQ for a little bit. I'm going to go take a quick break and stretch my legs. When I come back, that's all the pictures. We made it through all the pictures. So the last half of the class belongs to you guys. I want you to tell me what you want to talk about. It can be momentum. It can be areas that are broken, areas that are not broken. It can be entries. It can be momentum trades. You tell me what you want to talk about. We'll talk about it. I'll be back in about 5 minutes. All right, guys, let's finish strong. Bad top, right? Same lesson. Not a decision-making point. Not an area where buyers and sellers are like, man, I got to get in or get out. Pushes all the way back to the mid-band. Closes the gap all the way to the triggers. You guys recognizing the patterns? If you took a shot at the short right here with no divergence on a 50-50 from a bad top says it's not likely to work. And then from here, right to resistance, once again, we see a reaction. And you're kind of in that little holding. Guys, is it going to break or is it going to hold? I think it's going to break. I think the buyers are trying to get to the next level. But my rules aren't met yet. Actually, that's not true. I probably would have been long here. But do you see how the pattern keeps you from being sold on the short? Bad top, mid-band, full bar away. I'm not trying to go short here. I'm not trying to go short here. And now we're waiting for everything to come together. Killing me, TLC. Smalls break, pulls back to support, off it goes. I love it. That's textbook momentum trade. With odds favorable, momentum here. Smalls break the area, price breaks the area, pulls back, giddy up. That's textbook. I love that trade. That trade makes me happy. I take that trade 3 or 4 times a day. Everything is based on the large chart with momentum. Grant, that's one of yours too, right? And check it out. Smalls don't break, there's a bounce. Smalls don't break, there's the bounce. Smalls break, there it goes. It's a good lesson there on patience. Great lesson there on patience. $50-50 with divergence. We'll see if it works or not. Guys, what do you want to talk about? There's a big grind up in crude. There's a 50-50 on the RTY. Nope, that's probably old. There we go. Resistance breaks, behaves as support. I pulled up the RTY. I think it's kind of cool. It seems to flow nice. For you guys that are looking for something else and the S&P is moving slow, the RTY seems to flow a little bit. It's only $5 a tick. So it's the same price structure as the NASDAQ, but with a quarter of the speed. Not a bad one to go back and look for patterns on. All right, guys, what can I do for you? Oh man, 50-50 with divergence didn't go from the mid-band. Son of a gun. Would have never thought that was possible, not in a million years. Is anyone else as surprised as I am? You guys know I do this almost every day. I want you to look at this picture. I want you to burn it into your memory. Whoops. And then I want you to look at this picture. See if I can put them side by side. What do you guys think? Does that look kind of familiar at least? Triggers up, back to the mid-band, weak triggers in. Termination condition looks like it's going to hold, at least for the moment. When I talk about trading patterns, the more you go back and study patterns, the less likely you are to get caught in that long, right? The more likely you are to say, it has to prove it to me. It has to tell me that the area is broken. My small triggers aren't even through yet. And it might still go up, but I don't have a rule met yet. And if I don't have a rule met yet, why do I keep going long? No divergence, strong triggers, I might take that one. Divergence breaks the KISS plan. Second divergence breaks every plan that I own. It may be TLC. Do you know exactly why you took it? Do you know how to repeat it? Do you have 50 pictures of it to make sure that it wins more than it loses? So if you take that trade 100 times, TLC, how many times do you suppose you'll win it? With the triggers that strong on the large chart, breaking the area, you think 70? Did you just make that number up? So you take 100 of those trades and you win 70 of them. The only way, my friend, you could lose money is if you have completely ridiculous stops. Wouldn't you agree? It's a statistical advantage. It's a low-risk trade. I just wondered. Do you guys know that 68.4% of statistics are made up on the spot? Some of you will get it. What's your problem, TLC? Consistency? Your stop? Where was your stop on this trade? Whoops, hold on. 71.2. Gino. I love that we're all jaw-jawing now. That cracks me up. Okay. So where's your stop on this trade? I'm just curious. There isn't a right one, there isn't a wrong one. Is it the white line represents your stop? No. Was your stop behind this one, behind this one, behind this one, behind this one? Just curious. And there isn't a right or wrong answer, TLC. I'm not trying to put you on the spots, and I'm not going to beat you up about it. But management's a big part of what we do, right? So let's think about it. If the small triggers have broken this fib, right? And my goal is to pull back to this fib, and I'm expecting the fib to hold. Can we say that's exactly what you're hoping for here? So your stop's all the way down here? Right here? Okay. So what you're saying is your expectation is this fib is going to hold. But because they've already created a little something something, you're going to leave all this risk on the trade for a momentum style trade. Could we agree, and this is all in theory, that if this pushed all the way down to there, it's not really a momentum trade anymore? That would be a reversal bar. That would be on the wrong side of the smalls. That would be on the wrong side of the fib. That would be on the losing side of everything. And this is one of the great things about these momentum trades, is that if I'm expecting this fib to hold, if my pullback, snap back to the fib is where I enter and where I expect it to bounce, I like your white line. And you bought it on the way up, right? Or did you jump in and then it pulled back? And I'm going to see if I can find a momentum style trade that I can give you a pretty good example of what I mean. When the area breaks and then it pulls back. You got in on the pullback bar. Okay. So it pulled back and then went back up and then you got in. And the timing is important, right? The timing is very important when discussing it. And if you're getting in, when it's going back up, that's even more brilliant because you let it hit the area and the area told you that it's likely to hold, and you've already got your risk established right below the bar. Does that make sense? Okay. And this is just part of it, guys. All we're doing is Jen, you can't say tards. It's politically incorrect. Sorry. Let me see if I can find a momentum trade for you real quick. That shows you exactly what I'm talking about. I don't know. I've got so many pictures. Here's a good example. Where it pulls through. I know, Rob. I'm kidding. And then pulls back, right? So if you sold right here, well, that's looking like a trend trade. But the idea is the same. You have to put the stop where you don't expect the market to go. And if you're relying on this to hold, it's okay to have that tighter stop. It's a great trade, TLC. I love everything about it. And Ms. Jen, we will talk about every trade that you want to talk about. Every trade that you want to talk about. So let me see if I can line this up. 1554, 1554. And TLC, you're going to hate this. I don't care if you guys win on the wrong trades. Like I'm glad anytime you guys don't lose. But if you don't know why you're doing what you're doing, if you don't know how to repeat it, if you're not sure how to manage it, well, then that means that there was an element of luck, right? So we want you to be able to do the same thing over and over. So guys, when I pick apart these winners, I pick them apart with the idea that we can work to consistency. Everything says up, Miss Jen, and I'm trying to line them up. It's a big picture. Hold on. It's a big picture with really small stuff on it. And I'm old. 54. Everything says up and it pulls back. Everything says up and it pulls back, and you get in at the mid band. No, you're good. One of the OG kids. No, I got you. No, don't be sorry. Do not be sorry. You got in at the mid band, but price didn't make it, so no trade. And then you get out at resistance, which is a beautiful exit. And then here oh, there's the mid band right there. I'm looking at the mid right here. Okay. So you get in at the mid band and take it up to resistance when everything says up and clear. I got you. I'm with you now. I'm a man, Jen. I don't communicate well, but I get there eventually. But then you have reasons to get out at termination conditions, right? And you have 3 divergences. So this is where annotating charts is so important. What prompted you to buy the market again into a termination condition with 3 divergences in the same price range? This is, it's textbook termination condition. And you got away with one here, very much. You got away with one. And it did go up to the next area, it looks like. Hold on. All right. Just so terminology is consistent. The separation between the small and large is momentum. The one line inside is the slowing of momentum. And then when they get back inside, anything can happen up or down. And it's kind of a life cycle of it there is what you're looking at. And let me see if I can find, I've got a picture here. And that's the one. This is a good one. This is our best of the best. This is the one that breaks areas typically. This is the one that really pushes the market. This is the one, that's the best look ever, Miss Jim. This is that slowing where you can still get away with some stuff, but it's got to be better. And then this is where bad things happen at areas. I love your first trade, and let's just go through the difference between the two. Your first trade, whoops, so much greatness on these charts. Your first trade hadn't reached the area yet. I love it. Taking advantage of that extended trend, everything's up, everything agrees, giddy up, let's hit that area. And your exit is beautiful, 100%. And then when you take this next entry, it works. It does. This market is pounding to the upside without a doubt. Because you wait for the mid band, you've got very low risk. The only thing that I would say, Miss Jen, please, please, please keep in mind is that if you run into a problem here, it's okay to get out of that trade. Just identifying the trouble spot. This is a strong trending market. Your entry is beautiful and it gives you time to manage into the area. It's just starting. You're going to be floored at how smart you are 3 months from now. And you're going to be even more floored at how smart you are a year from now. And 3 years from now, you're going to be like, oh, Mark, move over. I'm teaching the class. Absolutely. I'm glad to share my time with you guys. So let's go live market. Week top, termination, termination, termination. They're winding up for something, aren't they? You guys remember when I said decisions are made at key areas? This market came from a termination and they railed to the upside. Jen, there's your long, there's your second long. And now we're into problems and we're just watching them dance in between areas, guys. Triggers are down, but direction is up. Path isn't clear either direction. This is where people try to predict. I think the market's going to do this. I hope the market does that. This is where the smart trader sits on his hands and says, let these guys fight. If we get above 18,101, I'll look for longs. If we get below 18,090, I'll start looking for shorts. But until that happens, I do not have an advantage. Does that make sense, everybody? The hardest thing to do is absolutely nothing. It always has been. Here's weak triggers. The path is clear, and I don't have any areas inside of favorable large triggers. I'm giving up 2 out of 3 advantages. And let me show you why I'm saying this. And this has been a pretty strong uptrend. But with weak triggers and divergence weak triggers, I could guess that that area may hold, but it might come back here. It might come back here. This might hold, or it might go all the way down here. And the reality is I'm not sure. But what I do know is that I don't have a market that's likely to continue up. Is everybody okay with that idea? Without strong triggers, there's indecision. Without strong triggers, it's difficult to know if it's going to be a short pullback, if it's going to be a longer pullback, if it's going to be the longest pullback, or even if it's just going to be a full reversal. I just don't know. Which means if I decide I'm going to go long right here, is it okay to wait for some sort of confirmation? Is it okay to wait for maybe a reversal bar? Something that says that they still want to go up? And these are the things that you have to ask yourself. All right. The divergence numbers and their relevance. All right, Jen, this is going to be the shortest talk ever. There's none. There is absolutely no relevance. So check it out. 31, 64, 42, 31, 10, 18, 88, 122. All of these negative numbers are nothing more than a byproduct of the calculation that's running behind the scenes. So when divergence comes to be, and I like the lesson because it's easy to get suckered into bigger numbers, little numbers. All divergence is it is a comparison between the swing in the market and these MACD BBs down here. And 15 years ago, Nexgen users had to do that comparison themselves. They had to be able to look at this in the moment and decide whether or not it was higher, lower, lower, higher. My brother automated it. But what happens is you start to see these numbers, and they're a byproduct of the calculation that's going through here. And what's really important, the only importance is that if you see the number, you know that divergence is true. And if divergence is true, it just means there was a loss of momentum. I had it explained to me, divergence is very much like pregnancy. You either are or you are not. So if the negative number prints and the line prints, well, then you know that there was a loss of momentum. That's all. It really is that simple. So without strong triggers, without an area inside of favorable large triggers, is anybody else happy that their rule said don't go long? That's your Spanish laugh. I like everybody is bringing on a Spanish laugh now. And now it's weak triggers with divergence, guys. So patterns tell me they might be trying to get down to the mid band. They're not guaranteed to, but that's a pretty likely outcome based on patterns that repeat themselves over and over in the market. So let's go see if we can find that pattern more than once. Weak triggers with divergence almost to the mid band. Weak triggers with divergence pulls up to and a little bit past the mid band. Weak triggers, bigger push. Weak triggers, divergence. The beginning of the down move at the termination. Weak triggers, bigger push. Strong triggers, retest. Weak triggers, down it goes. Same patterns, guys, all the time. Over and over and over. And then just to revisit, remember when we talked about, I just don't know, but these are probably my options? Guys, I knew that when everything was going up. That's just chart reading. So it keeps you from getting married to the long. And I feel like a lot of times I tell you guys, it's just not your trade. There's just not an advantage. It's not the best look, right? Why do we do that? Because if you can avoid losses that are unnecessary, if you can avoid losses that don't have a statistical advantage, you're going to get more out of your trading. It's going to be easier to let the profits run. And I'm going to tell you right now, there's nothing more frustrating than being up money, making 3 mistakes, and then being down money. Because mentally it takes a toll on you. Mentally it makes you change the dynamic of your approach to the market. So always focus on advantages. Guys, if we got a pullback to resistance inside of those triggers, could we go short to try to get to the mid band? What do you guys think? It's a 50-50. What if we got a no divergence pullback to the area? Based on the pattern, you think we could take a shot at getting to the mid band? Well, it doesn't look like they're coming for us. But there we go. There's the box from 4 minutes ago. And now we're at the mid band. Now we're at support, and absolutely no triggers are through. Rob, that all depends on you. Get used to taking 200 instead of waiting for more. So in the beginning, if you just are trying to be consistent, I love the idea of just focus on getting paid, right? In the beginning, focus on getting paid. Keep it easy, keep it simple, protect yourself, get out, make quick money, feel good about it, have easy targets. It's so easy. And then Rob, the better you get with reading your indicators, the easier it becomes to hold for bigger moves. When the path is completely clear, when we're coming off of resistance, when momentum is the strongest, doesn't it make sense just logically that this market's likely to push down? If everything is red and aiming down, if everything is screaming to the downside, just logically, it makes sense that it's probably going to push down. So, Rob, as a brand new user, that might be it. As you grow, you may hold for bigger moves. And guys, this is one of the reasons why I want to see the after of your trades. And these are all from the spreadsheet. That's a 50-50 trade. This guy took an entry. When divergence printed on a weak trigger 50-50 trade, he chose not to exit and got slaughtered. Right? He jumped in too soon and he jumped out too late. And guys, this isn't a bad trade. I'm not showing this because it's a bad trade. I'm showing this to let you know that great entries create manageable trades. So Miss Jen, when I was saying I loved your entry because it gave you time to manage, this is the exact scenario. Because once that divergence prints with these weak triggers at an area not broken, guys, there's no reason to ever lose money on this trade. And this is right from the spreadsheet. But the cool thing is every time you take a trade, if the only thing you're worried about is the entry initially, well, then you've got to be able to go to that next step. So here's a great example. The perfect entry on the long profits at the first target, and the rules say with weak triggers, a second divergence will probably take me out of this trade, and the stop is appropriate. They're trying to get the target because of the move, but they're not willing to risk $500, right? They've already been paid. They're not risking a lot. It either goes or it doesn't. And guys, these are the things when you show your entries and your exits, when everything is strong, is there any reason to jump out with this look? If the only thing you were looking at is this chart, can you think of any reason to get out of that trade? That's nothing but fear. So show me what happens after, right? Here we go. This one says if divergence prints on a 50-50 trade. 50-50 trade, no divergence, easy entry, out at the yellow 1-to-1s, divergence prints, get the hell out. Don't hang on to it. All the way up there. So all of these, every one of these pictures that I just showed you are in the spreadsheet. So if you're working on management, wouldn't it be awesome to go through and say that with odds favorable and a clear path, one divergence isn't going to scare me? One divergence is going to keep me in that trade, and I'm going to ride that wave all the way up to resistance. In the beginning, you may get in at 52, out at 62, go break even, get stopped out. There's your $100 from the KISS plan. And then when you grow with the software a little bit, you're going to say, well, shit, all my rules are still met. This is the perfect trade. I'm going to keep my stop where the market shouldn't go, and I'm going to ride that one to the next level. So it's just a process, guys. All it is a process. It's understanding patterns, taking advantages, and just compounding. Weak triggers, divergence prints, all the way to support, all the way to support. Gap theory, Ron, close on the correct side, out before the reversal bar marker. That's the gap theory, 100%. Take care, JW. Nice trade, Ron. And then here we'll decide if it's going to go up or down. Support's still holding. No opportunities to get down to it, though. Support held. Triggers are strong. Here's a good lesson. Guys, do you notice how the triggers reached the area but price didn't? Give me a Y if you see that, please. The triggers reached the area. Price did not. Is it a termination condition? No, exactly, Tony. Because price sets off the decision-making process, guys. Price reaching the area is what sets off the decision-making process. Great job, everybody. That wasn't a termination condition until price reached it. And you notice that when price reached it, that's the first fluctuation that you see on the smaller, faster chart. All the way up to it, before it hit it, didn't do a darn thing, even though the triggers were there. Once it got there, you saw that little dance. Ron, have a good one. Enjoy. Guys, this is the NASDAQ. This is a termination that created a full reversal that provided odds favorable momentum that is giving a pullback. TLC, there's your trade right off of support, right? With all that momentum and a termination. Some of you guys are long at 978. Some of you said, no, it's a 50-50. I'll let it come back and give me the trend trade. Nobody's wrong. Everybody's got a different trading style. Everybody's got a different way to do things. That's the beauty of it. Grandpa said that if we are all into the same stuff, everybody'd be chasing grandma, and that would just be exhausting. So let's wrap up class, guys. Broken record one more time. To minimize your learning curve, can't stress this enough, to minimize your learning curve. Post your trades in class, guys. Cav, take care, man. Great trading today. Post your trades in class. Every trade, win, lose, or draw. If you win and the rules are wrong, you may have a short-term victory. It's a class isn't over, guys. You still have time to ask questions. Long-term failure comes from getting lucky, guys. How are you going to know the difference? You need feedback. I'm here to help. Get on that simulator. Place your trades. Participate in class. You can't lose money like that. You can't lose money practicing. You can't lose money back testing the software to make sure that it works. We give you a 100% free working copy of the software. Make sure you have NinjaTrader. We give you rules, provide you a plan, and give you feedback for 15 hours every week. The only way you're not going to get this is if you don't put the work in, guys. You got to put the work in. You got to get feedback. It's the best software in the world. Oh, look at that. Best software in the world. It's like the most expensive hammer you can buy. You're not going to build anything with it if you don't learn how to swing it, right? This is the NASDAQ, and the small triggers are below the reversal bar marker. For some of you, that's a red flag saying, even if I'm going to think about longs into a termination with all the triggers below, I'm at least going to take a close on the correct side of the triggers. And it could go up. We'll see if the triggers behave as resistance off that termination condition. This is where fortunes are lost in the NASDAQ. What do you think? So far, triggers for the win. Cindy, have a great afternoon. Tony, I know you're learning this one. Does that make sense? You know where the spot is. Now we're just being a little patient. Gonna wait and see what happens. I don't know what's gonna happen. I don't trade into termination conditions personally, but if you're one of those people that are so inclined, did you guys learn anything today? I hope. Hope you did. Man, small triggers for the win. Oh, you're welcome, Jen. Guys, every day the idea is a little more clarity. Did you guys see it? Everybody wanted to go long at the mid-band. Small trigger said, hey, be patient. You don't have to jump in. You don't have to be first. I love that. Man, the repetition is key, Arnie. If you were with me 2 years ago, you heard the exact same first hour. It's true. If you were with me 2 years ago, you heard the exact same first hour. It's still a termination condition, guys, but if it closes above, then you at least have your risk in place, right? And you know where your trouble spot is. I don't know, where's 770, 725? That's $100 right there. Go break even. But do you see how waiting gives you an advantage? Tony, that was just for you, man. And now if you wanted to, you could take profits at that fib and say, hey, it's likely to go. I don't think so, Tony, or I'm sorry, Arnie, one thing that's cool is, are you familiar with the buy stop, sell stop? So what I do is if I know that I have to, and this was a little impromptu because we're right in the middle of class. You guys remember it's still a termination, right? I'm not risking everything. I already got paid once. Support either holds or it doesn't. It either gets me or it doesn't. But I do have momentum. So what I'll do, Arnie, is if I'm waiting for a close on the correct side, is I'll use a buy stop. I'll have that buy stop in place already, and I'll kind of chase my reversal bar down so that if it does close on the correct side, I don't have to try to time it out. Oh, and look at that, it got me. And it might still go up, but I'm on the wrong side of the large, right? My small's turned against me. I don't have a clear path. No, Rob, an ATM is your strategy. So the ATM is how many targets, where your stop is, where your profits are, all that good stuff. Buy stop says if the market comes up to 150, instead of buying a limit order on the way down, I'm getting in if price reaches this area. So these are great if you have to have a close above the small triggers, right? I would have had a buy stop right here. So if my entry requirement says that I have to have a stop above the small triggers, I would literally have a stop or an entry waiting right here. And it would just help me get the best fill. So the ATM is the strategy. Yeah, so it's a limit order says if the market comes down to here, then I'll buy. There we go. If the market comes down, I'll buy. And guys, I'm not saying this is a trade. And then a buy stop says if I get a reversal bar, if price comes up to this reversal bar, well, then I'm going to get into the market. Does that make sense? So the limit order is used on the pullback. A buy stop or a sell stop is used if you need a reversal bar to get you into that trade. What you're working on right now with the high probability trend trade, you should be using limit orders at areas inside of favorable large triggers. That's your path right now, I believe. And then as you grow outside of that, or if you take on the NASDAQ at some point, that'll change a little bit, potentially. But Arnie, that's been really helpful for me with my NASDAQ trading. Because what it does is it forces me to not clip that button, to hit sell right here because I'm so anxious. It forces me to wait for the best trade. Some of you don't need that forcing. I might be a little cavalier. Allegedly. So, just one of those things that helps. And then Jen, do you see how since we had already defined our problem area, we knew that we had to think it out a little bit? It's easy to get caught up in the decisions. And of course, there it goes. So now I've got weak triggers, but I do have a clear path. Got weak triggers and a clear path, and I do have an area inside of favorable large triggers. But the key here is where, my triggers are below my reversal bar marker as it comes back. So Tony, there's a live version of when I will cancel my limit order and wait for the retracement. And now they're kind of above, huh? No, they're down. So I'll be patient, especially with weak triggers because it's not perfect. And it's pushing, and if it gets to 104, that's where we expect it to stop. But notice how my reversal bar marker is buried inside of those triggers? I need it to be on the other side of those triggers, which means that if I'm going to get long, I've got to give it a second to confirm. I don't like this trade with weak triggers, with divergence. But if you were inclined to take it, that would have been how you have to do it. You have to be okay with the amount of risk that entry produces. Divergence represents the first trouble spot, or you can do $200, which is $16.50. If a second divergence prints, you have to exit. I'll know that that's true somewhere right about here, so I can reduce my risk. But now we're just taking advantage of support likely to hold. Triggers up, triggers up, triggers up, close on the right side. It's trying so hard. And it may not work, guys. I don't know. But at least now you have a conservative way to take it, right? And my management says if a second divergence prints, then I have to exit the trade. So until that happens, whoop, there's my first target. How about if I go break even into the trouble spot? And we'll see what happens. Tony, does that make sense though? Oh, Grant, I never give advice. I'm not allowed to do that. It gets you in a little later, but if it's the right trade, you can still make money. If it's the right trade, you catch that one, Arnie? And this is why having room to targets is so important, especially on the NASDAQ. Because if you're waiting for that correct side, not having room is detrimental. And notice that it hit the divergence high to a tick. I'm not going to risk anything on this trade. I'm going break even into that trouble spot. And it's either going to break or it's not. Jen, I think, what time is it on your computer? And there's the problem. You and I have different midnights, which means that we started measuring swings at a different time, which means that we have a different number of calculations, which means that there will be a discrepancy in our fibs. If you're able to, go Eastern Standard for the United States, and we'll have the exact same midnight. Have I had any conditions to take it out yet, guys? Has anything changed on this trade? I'm in, I'm paid, I have no risk. There's no reason, right? And this is where you have to decide, am I going to hold on to it? Or will I let another divergence take me out? Or do I say everything says up anyway? If I get another reversal bar, I'll put my risk behind it and let's see if it finishes the move. Now I've got even less risk, and bingo. Welcome to Nexgen, ladies and gentlemen. As long as you have a plan, it's pretty easy. It just takes a while to practice. And no matter what happens next, guys, I'm pretty cool with the profits that I just took. So let's end class with that. What a great way to end class. I'll be back tomorrow morning at 9 a.m. We'll do it again, guys. I'm going to shut down YouTube